Targets. The economy is not doing as badly as some suggest. That has given some momentum to iron ore, so that brings us to the focus to Rio Tinto, for example, may move on the back of this. BHP as well is another one to look at. You saw, of course, basic resources, that sector yesterday in the European session gaining almost 2%. So we're keeping an eye on basic resources, Rio Tinto, BHP, on the back of higher iron ore prices.
Well, you're going to have a very boring show in the next hour.
Sounds
nothing
dull,
to pay
we haven't even touched on Tesla and Elon Musk.
Oh boy, oh boy. I don't think we can go there, Tom. There's two, the numbers I just can't wrap my head around.
It's a challenge, isn't it?
It certainly is, Tom.
Poor old Elon Musk.
Poor Elon Musk. Tom, thanks so much. That's Tom McKenzie, our European markets anchor, and of course he'll be back in just a few minutes to walk you through the open with Francine Lacroix. Again, that's just in a few moments' time. All right, so we are heading up to the market open. Futures pointing positively this morning. There is a tinge of risk on. We're looking at some of the havens underperforming, so while stocks are mimicking perhaps some of the new highs in the U.S., the yen underperforming. We're looking at a more or less flat dollar. Bond market pretty much calm. That is hanging tight, allowing perhaps for some of these gains to show through. All right, the European market open is up next. This is Bloomberg.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Welcome to the European Market Open. A minute to go until the start of equity cash trading. I'm Tom McKenzie here in London, and here are your top stories. Another record for the S&P 500 equities rally, underpinned by strong earnings. Global stocks and futures push higher. Facebook rises in late trading despite a maelstrom of bad news. The stock gets a boost from a $50 billion buyback and a pickup in user growth. Plus, blowout results for UBS. The bank reports its best quarter since the financial crisis. More from our interview with the CEO this hour. The futures then just clinging on to gains here in Europe. We talked about that record close over stateside. It was earnings that was driving that momentum for that record. Facebook in focus with those additional users, that share buyback, and the banking sector as well, looking positive. You had those strong earnings from HSBC, UBS coming out as the other European bank, pointing to that increase in fees, particularly around the wealth management side of the business. Let's check in then on how the markets are opening this Tuesday morning. The FTSE 100 gaining 0.2%. The interest and the focus here is certainly building towards the budget announcement from the Chancellor, Rishi Sunak, about £43 billion essentially in new spending that we're looking at. That is going to be announced on Wednesday. We've had drip of news around that, but the big announcement will be tomorrow. The DAX is gaining 0.3%. The CAC Cajon is up as well. By the way, for the UK markets, basic resources, iron ore, also a factor. We'll discuss that shortly. Spanish IBEX is flat. Let's move it on then to some of the other individual assets that we're looking at this morning. We talked about iron ore, the fact that the state media in China have come out and tried to assuage some of the concerns around the growth trajectory for that economy, and that is certainly pushing up iron ore prices. That brings our attention to what's happening in terms of basic resources. Gained that sector almost 2% yesterday. Here is iron ore trading currently then. We don't have iron ore in the mix. We do have crude though, currently down just over 0.1% at $85 a barrel. The focus, of course, on the supply-demand dynamics around oil and what that means for underpinning inflation concerns as the debate continues. And you heard this from Janet Yellen, the US Treasury Secretary, over the weekend, and that was parlayed into what we heard from Larry Summers on Twitter, pushing back on Janet Yellen's view, saying that inflation is more of a concern. The US 10-year currently, the yield at 163, so just edging a little higher there in terms of the yield. The futures in terms of the NASDAQ and the tech complex, because this is important on a big tech earnings week, gaining 0.5%. You had Facebook yesterday. We've also got on the docket the likes of Alphabet, Amazon, Microsoft as well. The pound, 137, so just a little bit of strength there of about 0.1% for sterling, and the oil complex, as we mentioned, down about 0.2%. Let's get the Bloomberg Business Flash then with Laura Wright. Laura.
Thanks, Tom. Hertz, barely 4 months out of bankruptcy, has placed an order for 100,000 Teslas in a move to electrify its rental car fleet. Tesla shares soared, pushing its value past $1 trillion for the first time. Hertz says the Model 3s will be delivered over 14 months for the US and parts of Europe, and is building a charging infrastructure to complement Tesla's superchargers. A study has found Bitcoin's ownership is still concentrated in just a few hands. According to research by the National Bureau of Economic Research, the top 10,000 individual investors in Bitcoin control about 1/3 of the cryptocurrency in circulation. The study also found the biggest 10% of miners control 90% of Bitcoin mining capacity. Citi is winding down its consumer banking business in South Korea. The US lender says it will continue to provide services for existing contracts until they expire or are terminated, but new sales will be stopped. Citi is refocusing its Asia and EMEA presence on 4 wealth centers: Singapore, Hong Kong, the UAE, and London. Facebook shares gained in late trading after reporting strong user growth in its social media apps and announcing a share buyback of as much as $50 billion. But in the earnings call, CEO Mark Zuckerberg flagged revenue headwinds stemming from Apple's restrictions on consumer data collection. He also called negative press around Facebook a coordinated effort to paint a false picture about the economy. I actually spoke to one investor yesterday, Tom, Freddie Late, CIO at Latitude Investment Management, and for him, it's all about this structural shift to online advertising. Businesses that formerly had bricks and mortar stores now advertising primarily online, which is an upside for Facebook.
Okay, that longer-term structural shift to pay attention to. Thank you very much indeed, Laura Wright here in London. Let's get into the key drivers then in the markets today. Joining us now is our markets reporter, Greg Ritchie. The earnings really driving that momentum then in terms of the record close that we saw on Wall Street. We've had more optimism around the data that's come out of UBS. Where do things stand? Can this momentum continue on the earnings front?
Well, exactly, Tom. It's about this earnings momentum kind of taking away the attention we had a few weeks ago on both inflation concerns and the prospects of monetary tightening from the Fed. Now we're talking about this positive earnings momentum. The question is what happens once these tech earnings are over. Will that momentum suffice? And I don't know, to be honest. It's a good question. Will the narrative strip back to the inflation concerns, or will we see this momentum return? It's a good question.
The next drivers for the markets then, as we continue to focus on earnings, particularly technology and further stocks this week, particularly with Alphabet, Microsoft, Apple and others. The focus around oil, though, we were talking about Brent being at $85. The commodity complex, iron ore, is well higher on the back of some commentary out of China. What are we looking at in terms of the drivers for oil? Is anything going to change around the signaling from OPEC+?
It's a really good question. I think the thing about the oil rally is that it's not so much the near-term moves, although they've been impressive, but it's the persistence of the move. We're talking about 6 quarters of advances. And just this morning, we've seen Saudi Aramco talking about how there has been pressure on output and there needs to be more calling on companies to increase output. Until these supply-demand dynamics occur, we're going to see the oil price slowly squeeze higher, and that's unlikely to change in the near term.
Further upside for the oil price, certainly Goldman Sachs with that $90 a barrel forecast, still holding on to that. Greg Ritchie, thank you very much indeed. Our markets reporter breaking down some of the catalysts that are driving the markets this morning and this week. Let's continue that focus then, bring in Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Geraldine, thank you for joining us this morning. What is your view then on what the next catalysts are if we look beyond the earnings? I want to get your views on the earnings, but as we look beyond for the moment, what are the next catalysts driving these markets higher? And is that upside, do you think, going to continue?
Sure. Good morning, Tom. I think it's exactly as you pointed. This is the time where the reopening boom is coming towards the end. There might be maybe a few quarter more of this because of all the headwinds that we had with various waves of COVID and shortages. That said, you need to look beyond to what is sustainable after this boom and which sectors are going to be really supported by the green and digital recovery. And this is where really all the difference will be made. And I would say that so far, especially in 2021, the market has been very myopic, very short-sighted, has focused on the reopening, but hasn't really thought about what is more secular and what is more medium-term.
A myopic focus from investors and from the markets. But let's stay on the short term in terms of these tech earnings. I do want to get your sense of how things are playing out. More than 80% of companies, not just tech, but in the broader earnings space, have posted positive earnings that have beaten estimates. What is the kind of key takeaway from you from the numbers that we've been seeing around the sustainability of some of these strong balance sheets amongst these companies and what it tells us as we look forward to the end of the year and into 2022?
Sure, in tech, you probably need to differentiate between software and hardware. I mean, software, is on a ride, and there's not been much changes, especially from the COVID time and the pandemic. But what's really changing is the hardware and what's happening there. And this shift of power towards the hardware maker, the foundries in semiconductor and all these things, where you really have pricing power, where you see those prices going up, where you see the demand in terms of volume going up. And we think that this is just not a one-hit wonder. This is something that is going to continue year after year, potentially, 3, 4, 5 years and more. And probably the market is having an attitude which is way too much cyclical relative to this hardware company and misses really the fact that the world being reinvented with this net zero CO2 targets, with energy efficiency, green mobility, solar power and all these things, and 5G, connected device and what have you, that this is really for the long run, and the valuations are certainly not taking this into account at this juncture.
Okay, and you point out the importance of looking at the CapEx implications of some of these shifts. How can investors align with some of that spending?
Well, you have to look at, what is going to have this strong growth going forward. And really what's happening now, I think, is unprecedented in our career. You have over 70% of the world GDP that is going to go for this net zero future. This has vast implication in terms of infrastructure into green energy, sustainable packaging, green mobility, machine vision, robotics and automation. These are very new sectors compared to the previous cycle, which was very much the internet and the cloud. Now we're really moving into this hardware era, and there are, you know, a number of sectors, like we mentioned semiconductors, but that could stretch all the way to forestries and what they have to offer in a net zero world. And it is this secular vision that PIMCO published about last week that we feel is not fully ingrained and absorbed by the market, and that opens the opportunities, especially in the equity market.
Okay, so try to align with some of those opportunities. There's been question marks over the ability for consumers to take on board some of the price hikes that we're seeing from some of the multinationals that they've announced in their earnings in light of the input prices and those higher costs. As we look to an era of higher capex spendings amongst these theme changes that you've highlighted, what is the consumer dynamic and how consumers adjust to these changing themes and the ability for consumers to absorb some of these price hikes?
Actually, the story might not be as bad as it seems, because what we've seen so far is that salary increases have been healthy. So in a way, this inflationary shock has been broadly absorbed by the excess saving from the fiscal expenditure of the government, and now is being followed through by some salary increase. But looking forward, because these things are not repeatable ad eternum, what we're likely to see is that this development of infrastructure is going to generate a lot of jobs, and the policies from government is going to be a lot more towards redistribution. So we're likely to give more purchasing power to those part of society that have much higher propensity to consume. And therefore, we should, in fact, see quite good growth with this redistribution that is like an ongoing secular factor, rather than something altogether negative for growth.
Okay, the optimism around some of that redistribution. Geraldine Sundstrom from PIMCO stays with us. Coming up next, we're going to have much more on the key drivers in these markets. And later on this morning, don't miss our interview then with the chairman of Leeds United Football Club, Andrea Radrizzani. We're going to talk about money in football. There's a lot of it, as you know, and much more. This is Bloomberg.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and like what changes they are actually bring to this market.
Countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
Welcome back to the Open. We are 14 minutes into the European trading day. We've got gains across the European stock 600. The benchmark for the region up 0.2%. The standout is the DAX at this point, gaining 65 points or 0.4%. The CAC 40 is flat. The FTSE 100 gaining 0.3% as we look towards the budget from Rishi Sunak, the Chancellor, on Wednesday. Earnings is continuing to underpin this optimism within the markets. Let's break it down, look at some of the stocks to watch. Top of the list, certainly in terms of our focus this morning, given our conversation with the CEO and these very solid earnings, is UBS, gaining at 2.4%. So net income for the third quarter, 2.3 billion, well above the estimates of 1.55 billion. Fees from investment banking and wealth management propelling that to the best quarter in terms of earnings for UBS since the financial crisis, and the markets rewarding them in the opening stages of this market this morning. Gains of 2.3%. Novartis is also up 0.6%. You saw better earnings per share, better sales. They have suggested, and they've kept their forecast for the fourth quarter. They're also looking at potentially spinning out part of their generic drugs business as well. Rio Tinto is flat. That is despite the fact that you've seen iron ore gaining on the back of some commentary from China, trying to reassure the markets about the strength, the resiliency of the world's second largest economy. Iron ore is up. Rio Tinto is currently flat. Basic Resources, though, yesterday gaining almost 2%. Okay, still with us is Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Geraldine, thank you for staying with us. How are you positioning then in these markets? Give us a sense of your regional bias at this point. A lot of people that we speak to pointing to opportunities in Europe as a result of the shift to cyclical and value. Do you align with that view?
Well, you have to be a little bit selective and careful. It's a bit difficult to say one region to another. In terms of asset class in our multi-asset portfolio, we still have a preference for equity as our, in our risk budget relative to fixed income, where we're still a little cautious given that yields are on the rise, but they've moved already quite a bit of way. Then when we look at regions and where we find the most sustainable possibility of earnings growth going forward, we tend to favor Asia and the United States among our equity portfolio. There are exceptions to the rule, looking at Europe in certain sectors like forestries that we like very much there, but it's more difficult to find true green and digital solutions among European companies than elsewhere. And we feel that when it comes to shortages, when it comes to input cost pressure, that a lot of the European companies are actually on the wrong side of the medal.
Interesting. So European companies potentially more vulnerable to those higher input costs. What is underpinning your optimism in Asia as concerns mount about the recovery in China, the real estate sector, and that rising number of defaults?
Well, when we look at, who are going to be the enablers of the green and digital recovery, who is manufacturing the kit for the rest of the world, we find that most roads lead to Asia, be it China, but also other countries like Korea or Taiwan or even Japan for that matter. And the concentration of market shares are absolutely incredible. When you look at, for instance, a solar panel, China controls like close to 90% of this value chain. When you look at semiconductors, you're going into very high percentages as well. So this is really an area that is finally regaining pricing power relative to the end users, given the scarcity. But also we shouldn't forget that during the tough years of the previous economic cycle, there has been a massive consolidation in some of these sectors, which has, given back the pricing power towards this company who also happen to have a technological edge versus some of their competitors in the West.
Geraldine, how far along the risk spectrum do you want to be when it comes to credit?
Well, we tend to still be in the relatively more secure part, like securitized mortgages, financials, like companies with very strong balance sheet. It remains to be seen how central banks are going to react to this bout of inflation that we are seeing. We think that over time, central banks want to remain accommodative when it comes to monetary policy. But, every week that passes by before we can see inflation going back down could could be a little bit unsettling for markets. So at the moment, we are a little bit cautious overall, try to stay pretty liquid in our exposure and waiting maybe for slightly higher level of overall yield to find buying opportunities. But, we're probably going to get there soon enough.
On the US, I know you're relatively optimistic about exposure to the US. We've seen some dynamics just in the last 24, 48 hours in terms of the negotiations over Biden's spending plans, but also on the geopolitics as well around Beijing and Washington, discussions there amongst key leaders from the Treasury, for example. What is the driver for the underpinning of that optimism in the US? And do you expect it to be sustained longer term as we head towards 2022?
Well, in the US, we have, companies, we have a household balance sheet, which are looking pretty good. And we're seeing, well above potential growth on an ongoing basis. When it comes to the US and China, this rivalry and competitiveness is going to change. But we are seeing certain signs of understanding that these two superpowers actually need to cooperate in some areas, like climate, for instance. I think that the US is deeply aware of the interconnection in certain part of technology, in green technology, and that they cannot do without China. So it's about looking at those areas of cooperation as opposed to confrontation and finding those places where, in fact, China will be able to sell quite a few things to the United States and vice versa, because we've seen quite a few licenses being granted to technological companies for exports to the likes of Huawei or SMIC.
Okay, Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Thank you for joining us for those insights. PIMCO coming out with their 5-year look ahead in terms of the age of transformation, some of the themes that investors should be looking at and unpicking. Okay, coming up, we bring you more of our interview with UBS CEO Ralph Hamers after the bank posted earnings that surged past analyst estimates. This is Bloomberg.
população é uma população importante, uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. Foi toda administrada.
So if someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
Okay, let's get to UBS now, reporting profit that soared past estimates. We've been speaking to CEO Ralph Hamers.
On one side, you see risk on the other side, you see the investor sentiment to be a little bit, careful around the inflation numbers that are coming up, and are seeking advice as to, okay, how do I best protect my wealth against upcoming inflation?
Where do you see inflation topping out? Middle of next year seems to be the building consensus. You agree?
Same here. If you look at the underlying factors causing the inflation, it's clearly the energy prices. It is some of the supply chain hiccups that we see. It is a bit of the friction in the labor markets that we see as well. We do expect, the consumer spend to move away from goods to services. Mm-hmm. That should help lift a bit of the tension on some of these as well. And at that moment, we also feel that the supply chain is probably up and running again. Demand will be a bit lower than for those goods, and then hopefully we'll get in a more balanced situation, and then the inflation will come down.
To China, we're trying to glean leaders like you, your take on where we are. The Evergrande exposure, your direct exposure is immaterial. You've told that to the market. I want to get a sense from you, has the worst passed in China with Evergrande and the reorchestration of the economy?
Well, they just announced the move to a common prosperity, right, in terms of their policy. So I do think there is probably more policy changes as part of that coming through. This time it was around the property market. I do think it's going to be also around healthcare. It's going to be about some social welfare as well in terms of unemployment benefits, building a pension system, et cetera, et cetera, et cetera. So I do think more changes will come to the market. Those will be all incremental. Some will have negative effects, some will have very positive effects. So for us, we will go through that. We've been committed to that market for a long time, and we see it as very strategic.
I was with HSBC yesterday. They were sort of almost full bull on China. Are you full bull on China?
I'm strategically full bull on China. Absolutely. Who can't be, right? We know the country very well. We're very successful in the country, both on the onshore business and the offshore business. We have a very good combination of businesses in the wealth, IB, and asset management business, and we plan to invest more.
UBS CEO Ralph Hamers speaking to Manus Cranney. Much more coming up. This is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
lot to us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Another record for the S&P 500 equities rally, underpinned by strong earnings. European stocks push higher. Facebook rises in late trading despite a maelstrom of bad news. The stock gets a boost from a $50 billion buyback and a pickup in user growth. Plus, $1 trillion Tesla, the EV maker's value soars after Hertz places an order for 100,000 cars. Let's check in then on the markets 30 minutes into the play here. You're looking at close to record levels for the European stock 600. We're not there yet, but we're closing in on that. The earnings momentum and optimism is clearly apparent in today's markets. Beckett Renkisser, by the way, in terms of personal care, driving that sector higher. They've raised their forecasts for the year. You also had that very strong beat by UBS. We've been speaking to the CEO. So gains of 0.2% across the benchmark. The DAX is up by 60 points, or 0.4%. The CAC Cajon is a little bit less optimistic at this stage. Gains of 0.2%. On the politics, by the way, Macron in the polls leading as we head up to elections in that country. The FTSE 100 is gaining 0.2%. Let's have a look at how things are breaking down sector by sector. We'll have a look as well at how iron ore and these higher prices are factoring into basic resources that did so well yesterday, gaining almost 2%. Basic resources now closer to the bottom. Maybe a bit of profit taking down 0.1%. Bottom of the list, though, is telecoms down 0.4. At the top of the list when it comes to sectors is personal care. Again, Beckett Renkisser, and that higher forecast is underpinning that. Retail also gaining 0.7%. That is the shape of play then as we look to more technology earnings out of the United States. And also, by the way, Christine Lagarde speaking on Thursday. She's going to have to push back on these market views that the ECB is going to have to be pulled in line alongside the Fed and the BOE to become more hawkish. That will be a challenge for Christine Lagarde. Let's get over now to Riyadh, though, Saudi Arabia, where our Bloomberg Middle East anchor, Yusuf Gamal Eldin, is attending the FII Institute Summit, and he's standing by with a very special guest. Yusuf.
Thanks, Tom. Yeah, it's been a busy couple of hours here in Riyadh, the jam-packed hall of the Future Investment Initiative in the Saudi capital. Lots of CEOs and top government officials. But let's get to our next guest, that is Bob Diamond. He's the CEO of Atlas Merchant Capital. Bob, thanks for making it to the set here. I look at break-evens, just to get a bit of a lay of the land with you. I look at break-evens, and investors are expecting inflation to be at the upper end of the Fed's kind of guidance for the next 5 years. The world we live in is with financial products that are geared towards benign inflation. How seriously should we take the warnings from the market?
So our view of inflation, I think it's similar to what you said, Yusuf, is some of the higher numbers we think are gonna come down. Core inflation is more between 2 and 3% the last couple of months. As we work through some of the supply chain initiatives where we think this comes out, is kind of 2 to 3%. Frankly, if it was at 2 to 2.5, I think it's exactly where the Fed would like it to be. They'd like some inflation. It's clear from what they've been saying. So we're not panicked about inflation, but it's certainly an issue. And we would think in kind of that 2 to 3% range.
I mean, in the past, you've said, well, over the summer, that you expect rates to be sort of at the lower end as we get to the end of the year. Do you still stand with that view?
No, I'm not. I think they'll be at the higher end over time, not by the end of this year. So if you add to the inflation things that we're just talking about, the fact that the Fed's probably going to be tapering from now through the middle of next year. And if I look at the 10-year note, that 1.5 to 3% range that's been consistent for 15 years with very, very few exceptions, still at the low end of that range, I would think over the course of 2022, it's going to move toward the high end of that range.
I mean, with a potential inflection point in monetary policy, maybe even in sort of government accommodation programs, is it on your mind quite a bit that valuations are stretched in markets at the moment, regardless of asset class?
Well, when you look at the alternatives to investing in a zero interest rate world, I think it points people toward equity. And I wouldn't say they're stretched, but they're at least fairly valued. So I think it's very, very much going to be a sector approach going forward. I don't think anyone would say that the equity levels are cheap here, for sure.
Let's talk about one of your key points of, let's say, interest and focus and allocation of resources, and that is around digital bank currencies, your involvement with Circle. What are some of the products in the pipeline, and then how does that put pressure on some of sort of the old school ways of banking?
Well, if you look at the earnings that came out of the big U.S. banks recently, they were phenomenal. But a lot of it was in the investment banking area and the asset management area, not kind of the core legacy bank. And to that, I think we'll see more of it. This is a bit of a segue in terms of the conversation, but certainly since the financial crisis, with the Swiss banks and the UK banks and the European banks de-emphasizing investment banking and focusing more on their core, the bulge bracket U.S. investment banks are just killing it. And it's almost like an oligopoly. The market environment is terrific. The advisory fees are strong. But if you go away from that, Yusuf, for a second and talk about core banking of taking deposits and making loans, it's frankly pretty sluggish. With the higher capital levels that came from the crisis, those activities feel a lot more like a utility. And I think that part of banking will benefit from higher rates, but it's getting hit a lot more from higher costs, lower loan demand, and they're getting hit particularly, to your point, from the technology specialists and the other specialists that are kind of invading the most profitable areas of banking.
So how much growth are you seeing in Circle specifically?
Yeah, so come back to Circle. We've recently announced our SPAC, Concord Acquisition Corp, is merged with Circle. We hope to close in November or December. And we see this as digital payments really competing with kind of that core treasury transaction services, commercial banking activity of the banks. It's not as much, looking at the consumer side or the retail side, but that commercial side. So a very, very profitable portion of the legacy banks over years. And we think there's a real opportunity for Circle and others who have a digital offering, taking advantage of the internet, taking advantage of blockchain technology. The ability to steal business here in that payments and treasury and transaction services section of banking is real.
What about blockchain equivalents for corporate bonds and equities? That's another area that Circle is working on, correct?
The blockchain technology, I think, has been critical to allowing, the payments business of Circle. And I think in addition to that, one of the businesses that we're building is the borrowing and lending of various digital currencies, right?
What about regulation, Bob? That's going to come in. It looks ripe for it. How do you think that's going to take shape?
Well, we need it. So it's probably not the answer that you were expecting, but I think, Circle now is very, very regulated. But the prime regulation is 46 separate states and a few in Bermuda and a few other places like that. And from the federal level, we really embrace regulation. We think regulation will be a positive for the stablecoin portion of the crypto business. And so we embrace it and we look forward to it. We've made a couple of announcements recently in Circle. One was that we're going to apply through the OCC for a full reserve banking license, which I think supports the fact that we would expect to be regulated as a stable coin or a digital currency. And we've also announced that the portfolio behind our USDC or stable coins moving to just cash and short-term treasuries. So, emphasizing that a dollar is a dollar is a dollar is very, very important, along with smart regulation.
Bob, great catching up. Thank you very much for making the time. That's Bob Diamond. He is the CEO of Atlas Merchant Capital. Tom.
Yusuf, great conversation. Thank you very much indeed. Yusuf Gamal, then our Bloomberg Middle East anchor at the FII Institute Summit in Riyadh with Bob Diamond from Atlas Merchant Capital. OK, let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The UN is warning the world is still heading for catastrophic levels of global warming, even after the recent national climate pledges. The report says without stronger targets, the world will warm 2.7 degrees centigrade by the year 2100. Australia, or one of the world's top per capita polluters, finally agreed to a plan to zero out carbon emissions by 2050. Prime Minister Scott Morrison announced the target days before he is scheduled to head to the UK for next week's COP26 climate summit. President Erdogan has dropped his demand for 10 Western ambassadors to be expelled from Turkey, de-escalating a diplomatic row that had shaken the lira. Erdogan said the envoys, including the US ambassador, had issued a statement to undo the, quote, slander caused by their earlier joint demand for Turkey to release a businessman and government critic. China's Vice Premier Liu He and US Treasury Secretary Janet Yellen have spoken on the phone about the macroeconomic situation and cooperation between the world's two biggest economies. China's Commerce Ministry said the conversation was, quote, pragmatic, candid and constructive, and that the two sides agreed on the importance of strengthening communication. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
OK, Laura, thank you. Coming up, how the world's leading cities for career women are failing them in several ways. We've got the Bloomberg Big Take. That is next. This is Bloomberg.
Is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 44 minutes into the European trading day. The European Stock 600 gaining 0.4%, closing in on a record. Earnings propelling this optimism. You've got the likes of Beckett Rinkus, by the way, upgrading their forecasts and also increasing their pricing as well. That stock gaining more than 4%. And of course, you had the stellar earnings picture we got from UBS, and we'll be speaking to the CEO about that. Just crossing and bringing your attention to what's happening with the Turkish lira, because this was front and center for us yesterday on the back of these threats by President Erdogan to kick out 10 ambassadors. He's since walked that back, and now you're seeing the Turkish lira gaining more than 1% versus the US dollar. So that's the lira up more than 1% versus the US dollar, still the worst performing emerging market currency year to date. Okay, let's switch focus to the Bloomberg Big Take. And for the millions of working women in the world's leading cities, daily life is often shaped by what they cannot do and how they're excluded. A Bloomberg analysis of how 15 global cities rank for career women shows each failing in several ways. Joining us now is our Business Week editor, Rebecca Penty. Rebecca, thank you for joining us. What does the index do, and what were the main takeaways for you?
So I'll take you back to the original thinking about this index. Those of us who are here in London will be very familiar with the case of Sarah Everard, the marketing executive, 33-year-old, who was abducted, raped, and murdered in a London park by a serving police officer in March. In the wake of that killing and the furor that erupted, Bloomberg journalists sought to look at just how safe and how much equality is there for working women in some of the biggest cities in the world for business and commerce. So we selected 15 cities, including London, New York, Seoul, Sao Paulo, several others, and looked to rank them on various measures, not only including safety, but also wealth, equality, various measures like that. What we found is that women continue to be left behind. In many cases, they are absent from the managerial ranks in companies. In the cities where things are the safest for women, such as in Asia, they're left behind on wealth and equality measures.
Which they all perform very badly, these cities. Which are near the top, which are near the bottom? What lessons can be drawn?
Right. So Toronto in Canada, which is where I'm from, ranked 3.66 out of 5, out of a possible 5. So that gives you, and that's the best performing city. Sao Paulo is the worst. Now everyone else is in between. So that shows that inequality is rife everywhere. I can flag some other notable examples. New York, which is the center for business and finance, everyone thinks of it that way, is seen as very unsafe for women still.
What has the pandemic done to these cities in terms of the impact on gender equality or the lack of equality?
Yeah, we talked to economists about this very issue, and what we found is that the pandemic has made things worse for women everywhere, across the board. That's because working women still bear the brunt of childcare duties if they're also mothers. So they've been pulled out of the labor force or have been forced to juggle childcare. But also, the industries where women are most prevalent have been the ones that have been more disrupted by the pandemic. So if you think about retail, for example, consumer.
Okay, the challenges around cities trying to adjust and trying to make those improvements, as you say, Toronto near the top of the list, or at the top of the list, but still a huge gap to get to that 5, it's at 3.65. So the importance of this and building this out, I have to wonder, I have a 5-year-old daughter, I've got to wonder whether by the time she gets into the workforce, whether these changes will be implemented to finally see the kind of equality that we're looking for in our cities and workplaces. Rebecca, thank you very much indeed. That's our Business Week editor, Rebecca Penty. You can read the full take, the full big take on your terminal. Well worth doing that, or Bloomberg.com. Okay, coming up, investors still like Facebook. That's despite the revelations released in internal documents. We'll bring you the details of the social media company's earnings. That is next. This is Bloomberg.
OECD nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. 50 minutes into the European trading day. Optimism here in Europe. Gains of 0.4%, closing in to record highs after a record close on Wall Street. It is, of course, the earnings picture that continues to propel momentum here. On a sector basis, you've got personal care gaining more than 1% as a result of the range in terms of the forecast from Reckitt Benckiser, raising its forecasts for the year, increasing prices as well. It's basic resources at the bottom of the list, down 0.3%. You're seeing gains of 0.4 here in the UK. The CAC 40 is gaining 0.5, and in Germany, gains of 0.8%. Okay, let's switch focus to Tesla now, one of the big corporates that has drawn our attention. A deal with Hertz, and Tesla joining a handful of big tech firms now worth more than $1 trillion. This share price sent share prices higher. Elon Musk's net worth is also up by some, get this, $36 billion. That is the biggest one-day gain in the history of the Bloomberg Billionaires Index. Not a bad day's work for Elon Musk. Joining us now is Craig Trudell, our global car czar. Craig, talk to us about the importance then of this Hertz announcement. It was stunning, 100,000 Tesla vehicles. Can they meet that demand, and what does it tell us about the shift that we're seeing in the EV space?
Yeah, so what we reported was that this will be about 100,000 cars, about a $4.2 billion order, that this will be carried out over the course of more than a year. It's interesting that even Musk himself sort of, talked about the strangeness of the valuation going up this much. He talked about the idea that Tesla is a capacity problem and not a demand problem. That's been something that's been pretty consistent in terms of one of the things that he pushes back on when people have raised concerns over the years about whether or not they have enough demand to sort of keep the momentum going. But it's exactly that word that's playing out here in terms of momentum. It was just late August, actually, that Tesla was still down year to date. They're now up about 45% on the year. So this is a stock that has been going up both because of some fundamentals. The Model 3 yesterday we learned was the top selling car in all of Europe, not just electric vehicles, but cars, period. You have analysts getting more bullish on the stock. Morgan Stanley raising its price target yesterday. But I think what the Hertz order shows is really just another indication of electric vehicles becoming more mainstream, and a sort of signal that there are additional levers for him to pull beyond just growing sales to regular consumers.
And it's still, we've got a story as well on the Bloomberg about the fact it's still a junk-rated company, even though it's got a $1 trillion valuation now. Craig, I could pepper you with more questions. We're running short of time, though, but thank you for breaking that down for us. Our global car czar, of course, Craig Trudell, breaking down the implications for Tesla of that huge order by Hertz. Let's switch focus to Facebook. Shares rose in late trade after third quarter results showed more people are using its apps than analysts had actually predicted. The company is on the defensive after a maelstrom of bad news, including new details about Facebook's loss of younger users. CEO Mark Zuckerberg argued back in the earnings call.
Over the last decade, as the audience that uses our apps has expanded so much and we focused on serving everyone, our services have gotten dialed to be the best for the most people who use them rather than specifically for young adults. And during this period, competition has also gotten a lot more intense, especially with Apple's iMessage growing in popularity, and more recently, the rise of TikTok, which is one of the most effective competitors that we have ever faced. So we are retooling our teams to make serving young adults their North Star.
Joining us now for more is Ivan Livingston from our tech team. Ivan, Facebook shares actually rose yesterday post-earnings, up 20% on the year. What do you think investors are going to make of these results? So user growth increased, revenues were a little bit lower than the estimates, and then of course you have the challenges around some of these leaks and the whistleblower. Where do things stand with Facebook? How much should we be focused on the user growth and whether that's going to be sustained?
Well, Facebook has faced scrutiny for weeks over the media reports, the leaks, the documents, and so I think investors knew to expect that. They knew about some of the advertising challenges that Facebook would face with Apple's policy changes, and at the end of the day, it was the new user number that you mentioned, 2.8 billion daily active users, and so investors see that the company still is a resilient digital behemoth.
How are they trying to change the narrative, and are they succeeding?
Mark Zuckerberg being defensive, saying that the issues that Facebook faces are not specific to social media, they're societal issues, and he's pivoting the company to focus on the metaverse, this idea of a virtual world that he's developing, and pivoting to focus more on attracting younger users, a key demographic for them.
Okay, what about monetization of some of these areas like AR? Is that a reality for Facebook? What is the time frame?
Well, it's interesting. The company did break out its AR, VR division as a separate reporting category, which suggests that it expects that to be a significant driver of revenue going forward. But for now, it's still all about digital sales, digital ad sales.
Ivan Livingston breaking it out for us in terms of the implications for Facebook, its earnings, that user growth, and the digitization, and the future of AR as well for that company as a driver of momentum. Before we let you go, we're going to check in again on the markets. You're looking at gains in the Stoxx 600 of 0.4%. The DAX is gaining 0.8%. The UK, the FTSE 100, gaining 0.4%, despite the fact that basic resources as a sector is down by 0.3. The focus very much on earnings. We have Alphabet and Microsoft out of the US later. We'll see if that builds on this picture from Facebook. This is how things are shaping up as we lead into the next hour. That is it for the European Market Open. Surveillance Early Edition is up next.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that as either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
I'm strategically full bull on China.
The UK is setting very ambitious targets. I don't think any of us would have believed 5 years ago that the government would have set out their stall in this way.
These bottlenecks will not go away tomorrow. And the trouble is many companies have used their inventories.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Facebook rises in late trading despite a torrent of bad news. The stock gets a boost from $50 billion buybacks and a pickup in user growth. We're going to bring you the latest analysis. Seeming progress in U.S.-China relations. Janet Yellen and Li He address issues of concern, but 2 words from the Taiwanese president could derail the efforts. Plus, we discuss investing in sports. This hour, we speak to the chairman of Premier League Leeds United, Andrea Radazani. Send in your questions on IB plus TV Go. First, though, let's check in on these markets. And we are starting off the back of a record day in the U.S., a big day for U.S. stocks, a big day for big tech. Well, we're continuing to see those gains follow through, at least the European session. We're looking at gains of about 0.5%. Softer when it comes to S&P 500 futures, up 0.4%. But really notable here is the fact that it's still big tech that is the outperformer in this morning's session. That's up 0.7%. We have more tech giants reporting today. We have Twitter, we have Microsoft, among others. So some positive trades before that. How high is the bar set for those earnings? Finally, you're looking at Brent crude at under $86 a barrel. We saw WTI hit its highest since 2014 yesterday. Now, UBS has joined in its Wall Street rivals, reporting a third quarter profit surge. The surprise blowout results is the Swiss bank's best quarter since the financial crisis. We've been speaking to CEO Ralph Hammers.
On one side, you see risk on. On the other side, you see the investor sentiment to be a little bit, careful around the inflation numbers that are coming up, and they're seeking advice as to, okay, how do I best protect my wealth against upcoming inflation?
Where do you see inflation topping out? Middle of next year seems to be the building consensus. You agree?
Same here. If you look at the underlying factors causing the inflation, it's clearly the energy prices. It is some of the supply chain hiccups that we see. It is a bit of the friction in the labor markets that we see as well. We do expect, the consumer spend to move away from goods to services. Mm-hmm. That should help lift a bit of the tension on some of these as well. And at that moment, we also feel that the supply chain is probably up and running again. Demand will be a bit lower than for those goods, and then hopefully we'll get in a more balanced situation, and then the inflation will come down.
To China, we're trying to glean leaders like you, your take on where we are. The Evergrande exposure, your direct exposure is immaterial. You've told that to the market. I want to get a sense from you, has the worst passed in China with Evergrande and the reorchestration of the economy?
Well, they just announced the move to a common prosperity, right, in terms of their policy. So I do think there is probably more policy changes as part of that coming through. This time it was around the property market. I do think it's going to be also around healthcare. It's going to be about some social welfare as well in terms of unemployment benefits, building a pension system, et cetera, et cetera, et cetera. So I do think more changes will come to the market. Those will be all incremental. Some will have negative effects, some will have very positive effects. So for us, we will go through that. We've been committed to that market for a long time, and we see it as very strategic.
I was with HSBC yesterday. They were sort of almost full bull on China. Are you full bull on China?
I'm strategically full bull on China. Absolutely. Who can't be, right? We know the country very well. We're very successful in the country, both on the onshore business and the offshore business. We have a very good combination of businesses in the wealth, IB, and asset management business, and we plan to invest more.
UBS CEO Ralph Hamers there speaking to our Manus Cranny. Now let's get into some of the key drivers of the market today. We're joined by Bloomberg's Christine Aquino. Christine, through a lot of these bank earnings, we've heard just this deal boom over and over again, really helping to fuel earnings. How has that affected market sentiment?
Well, it's certainly helping shore it up, right? Today is very much a positive day because we're hearing from these positive earnings results. Banks in particular have really been enjoying this. And, you know, I think that really speaks to the potential for this sector of the market to rally a little bit more given this sort of environment of higher yields and more hawkish policy, which usually tends to go better for banks, right? But the flip side of this deal boom, of course, is a little bit of a caution there because it could well be the sort of ramp up in activity that we're seeing before, you know, we see the central banks like the Fed and other big central banks tighten policy and making it more difficult for companies to conduct business, making it more costly for them. So it's kind of like this pre-tightening rush that we could well be seeing that's fueling these earnings. So the question is this momentum going to continue into the fourth quarter, or is it going to peter out from here?
That's such a great point, because UBS, they even said within themselves in their earnings that, you know, they're not as positive that the client activity will continue at the pace it is because of exactly what you just mentioned. Let's talk about that environment a little bit being better for banks. Is it too optimistic to say that, yeah, we're going to have higher yields, we're going to have tighter banks, so yay, everything is good for net interest income?
Well, I mean, that's one side of it, of course. But yeah, as you mentioned, Danny, I think there's also other factors at play here, right? I mean, we've spoken extensively about this idea that in the environment of tighter monetary policy, that also has a trade-off for growth, right? And that has been some of the worries that have been surfacing across some corners of the market, in bond markets particularly, because, you know, we're already seeing signs of longer-term growth worries in the form of flattening yield curves, right? Which is usually, I mean, I know that the yield curve discussion has been a little bit distorted given central bank activity over the last decade, but still, you know, we're starting to see more worrying signs for growth in these flatter yield curves, which usually tend to signal less optimism about the economy. And so, yeah, definitely, I think those longer-term growth worries would be a little bit of a damper to, you know, the typical adage that higher interest rates would be good for banks.
Right. Christine, a lot of moves to keep track of. Thanks so much for joining us. That's our Christine Aquino. Now, I do want to get a quick check on what Facebook prices are doing pre-market. We heard them reporting earnings yesterday. Post-market, they surged this morning. They're up about 2.1%. This was after higher buybacks and some more time spent on the app itself also had investors excited about this as well. So we're also seeing NASDAQ futures lead the gains pre-market. NASDAQ futures themselves are up 0.7%. We hear from more tech giants later today, so we'll see whether that optimism can continue. In just a few minutes time, we will bring you a full breakdown of Facebook's result, as well as the torrent of bad news besieging the social media giant. All right, well, let's get more into this market and earnings conversation. We're joined now by Joanna Kirkland, CIO at Schroders. Joanna, first off, thank you so much for joining. Such a pleasure to have you in the studio. So we see tech taking off after Facebook results last night. Just how big do we expect big tech to get this quarter?
Well, I think it continues to be a sector that attracts flow. I mean, I think there's concern over the medium term about the resilience of earnings. Obviously, right now, we're getting a good cyclical upturn. But in the long term, this sector continues to be an area that delivers very strong structural earnings. And I think, yeah, interest continues.
Is there macro concerns overlaying this that might make you less interested in tech, sort of the long duration bend to tech?
Yeah, the big question for this sector from a macro perspective is what happens to bond yields. But right now, actually, the fact that Powell has come out and sort of indicated that he will respond to inflation if needed, in some senses does help to keep a lid on the long end of the curve and underpins valuations.
Well, I certainly know that you're a buyer in these equity markets, but what do you say to people who look at some of the volatility we've seen recently and say, okay, I'm just too terrified to touch this market? What is your advice to those people who just are too scared to step in and play?
Well, I think the reality is, yes, the easy money has been made. We've had the reopening trade as, you know, once the vaccines got announced. Clearly, there was a very strong cyclical upturn. Things are going to be more volatile from here, but I still think it's too early to get defensive.
So if the easy money has been made, where is the hard money to be made?
I think in general, we're still positive on equities. We're still focused on developed equities because that's where there's still the potential for cyclical upturn. And in general, yeah, very much focused on those markets. Yes.
Okay, so sort of the value play then is one that, you know, we definitely have had a lot of guests come on the show. Rob Arnott of Research Affiliates basically saying the spread between value and momentum is bigger than it was in the dot-com crisis. But in picking through those value names, how do you make sure you're not succumbing to value traps?
Well, I think there is an opportunity in value, so I would agree with that assessment, because again, the main risk to the market at this point is if bond yields rise too aggressively. And clearly, if value provides a bit of a hiding place because it's less exposed to that sell-off in bonds. So we do see opportunities there. And actually, I think at these levels of valuations, there are sufficient opportunities that we don't need to be too worried about value traps just yet.
All right, Joanna, we definitely have much more to cover. You're going to stick around with us. That's Joanna Kirkland, CIO at Schroders, sticking around. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we're going to be speaking to the CFO of Norsk Hydro as the aluminum company becomes a net power buyer rather than a seller. And later on, we're going to be discussing investing in sports with the chairman of Premier League side Leeds United, Andrea Radizani. Send us your questions for all those conversations at IB+TV Go. This is Bloomberg.
Crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
My view is that what we are seeing is a coordinated effort to selectively use leaked documents to paint a false picture of our company.
That was Mark Zuckerberg addressing the whistleblower leaks about Facebook's corporate culture. Well, let's go ahead and get a check on the markets this morning. We're looking at Facebook up 2.3%, so it's extending its gains as we head further into the pre-market session. Of course, we saw gains yesterday as well. Well, let's dig more into the tech earnings, more into Facebook earnings. Joining us now is our Ivan Levinston from the tech team. So, Ivan, we had this, this plethora of papers out yesterday talking about Tesla and concerns there from employees. Still not much of a reaction. It was a positive reaction to earnings. Why was it so resilient?
Well, we've gotten these documents coming out for weeks now. Investors know that there are issues with the company. There's negative reports. They know that Apple's policy changes are impacting the advertising business. And still yesterday, Facebook reporting that daily active users are rising, beating expectations. So that shows the company has a certain amount of resilience.
All right, Ivan, thank you so much. Really staying on top of this story for us. I know we've been putting you to work this morning. Definitely appreciate it. That's our tech reporter, Ivan Levingston. All right, well, let's continue the markets conversation as, again, we're coming off of all-time highs on these equity markets. And simmering in the background, of course, is the inflation conversation. Still with us is Joanna Kirkland, CIO at Schroeder. So, Joanna, we talked about equities a bit there. There's this degree that, there is no alternative, but we're seeing other assets react to these inflationary fears and supply chain issues, specifically commodities. What place do commodities have in your portfolio?
I think they still have an important part to play. So I'd say for the last decade, we typically avoided commodities because the main risk was deflation. Clearly now we're facing potentially more stagflationary fears. And so although commodities have already done well this year, we continue to own them. I think they're an important diversifier in the portfolio.
So stagflation, is that something that you're actively preparing for then?
I think it's a risk we need to consider because the challenge we're facing is that these supply constraints are actually acting as a sort of bind on growth to some extent. So yes, I think stagflation is a potential risk as we head into 2020.
What do you look for in judging that risk? Are there any key metrics, any key data where you say, okay, here is present really evidence that stagflation might be on its way?
Well, obviously, the main pressure comes from energy costs, which show no sign of abating right now. And the other key metrics we're watching are labour market statistics. We're missing millions of workers at the moment.
Right.
Our assumption is a lot of them will come back, and if that happens, then we've got plenty of capacity. But actually, there's a risk that a good proportion of them won't be coming back to the workforce. And in that case, we do potentially have some capacity problems on the labour market front as well.
Yeah, that's such an excellent point, really the conundrum of labour markets. Of course, another conundrum has been some consumer sentiment readings. Those have been remarkably low. We're getting another one for the U.S. at around 10 a.m. New York time this morning. Danny Blanchflower has said, look, this is a key ingredient of a recession. You need consumer confidence that is deteriorating. Do you see it the same way? Are you concerned about these readings?
Yes, again, I think the risk more, at the beginning of the year, we're very much positioned for reflation. I think the risk is more stagflationary at this point in time. So not a recession necessarily, but certainly concern that, in particular, these rising energy costs and also rising costs of shelter is hitting consumer wallets. And that's one of the reasons why we're not seeing sentiment being as strong as we'd like to see.
Yeah, sentiment not as strong, but bond markets certainly are having a reaction, seeing break-evens continuing to hit multi-year highs. Are we at the peak of some of these moves, or have they perhaps gone too far?
We think that over the medium term, inflation is likely to be somewhat higher than what we've experienced in recent years. So I'm not sure we're at the peak of these moves as such. I think there is still a potential upside risk to inflation expectations, particularly based on those measures of labour market tightness. As the output gap closes, the risk is that, again, we see wage pressure in 2022. So I don't think that inflation concerns are over yet. Having said that, I don't see the yield curve becoming unhinged either. The Fed, I think, has been credible in its response, and there are some question marks over growth. So I think the combination means that there's upward pressure on yields for now, but it's not out of control.
Yeah, so the Fed being able, I guess, to separate those two narratives of rate rises versus easing back of bond purchases. But what about when you look at other countries? When you look about here in the UK, you see rate expectations rising, yet you look at the pound falling. Is this investors voting with their wallets saying, look, we're concerned, it's not about rate rises, we could see even worse stagflation, even worse growth here?
Unfortunately, I think the UK is leading in the developed world in terms of stagflationary risk. So that is unfortunate for us here in London. We think that expectations of rate hikes from the Bank of England are actually overdone at this point. So I think there things have gone a bit too far because, again, confronted with these cost pressures hitting consumers, is it really the right answer to raise rates in the face of that? I think consumers will be hurting enough because of energy costs. So we think that concern's a bit overdone. And so in some sense, we would be in the camp of saying sterling should be somewhat weaker, and actually we're buyers of gilts.
Well, we were talking about this during the break where we had some of these tech CEOs, the Cathie Woods of the world, having this, what some would call a macro tourist debate on Twitter. We had Cathie Woods talking about perhaps some longer term forces, saying that the powers and converging disinflationary forces with AI, energy, storage, robotics, all these sort of things bending the curve. I'm wondering though, when we look at inflation, if you look further out and you agree with this sort of messaging that inflation won't be a problem further down the line because of things like automation, how long lasting is it just in that very, very long term view?
We think we are very much in a disrupted world, so I would agree that there are going to be pockets of the markets that are going to continue to have pricing power that actually won't be suffering from the impacts of inflation. So I think thematic approaches help to navigate some of those challenges from an equity market perspective. But I think over the medium term, we need to recognize that compared to the last decade, we are probably in a more inflationary environment than what we've experienced since the financial crisis.
Right. Joanna, I'm afraid that's all we have time for. Really great to have you on with us this morning. Definitely appreciate it. That's Joanna Kirkland, CIO at Schroders. All right, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we're going to be speaking to the CFO of Norsk Hydro, the aluminum company becoming a net buyer of power. And later on, we discuss investing in sport with the chairman of Premier League side Leeds United, Andrea Radizani. Send us your questions for all guests. IB plus TV goes where you want to head on your terminal. This is Bloomberg.
Talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's turn to U.S.-China relations now, where Chinese Vice Premier Li He and U.S. Treasury Secretary Janet Yellen have held economic and trade negotiations, which China described as pragmatic, candid, and constructive. With us to discuss is Bloomberg's Jenny Marsh in Hong Kong. Jenny, are these talks a significant step towards productive relations between the U.S. and China?
Hi, Danny. Well, there's definitely a change in tone from the combative Trump era. This is the second time that Li He and Janet Yellen have spoken recently, and it also comes after Biden and Xi spoke last month. Since that conversation, we've seen Huawei CFO Meng Wanzhou released in Canada, And that was one of China's big conditions for talks kind of restarting between the two sides. So it's definitely moving in a more positive direction, but there are still significant tensions left in the relationship.
All right, well, let's talk about some of those tensions. They certainly exist over Taiwan with some comments from the Taiwanese president. What's the story there?
So earlier this month on Taiwan's National Day, President Tsai Ing-wen said that China and Taiwan should not be subordinate to each other, which might sound like an innocuous comment, but in Beijing that really blew up. State media there said that Tsai was invoking the two-state theory, first put forward by Taiwan's first democratically elected president in 1999. That theory says that Beijing and Taipei should have state-to-state relations, which is something Beijing opposes because it considers Taiwan a breakaway province.
Right, Jenny, thank you for staying on top of all of this for us. We really appreciate it. That's Bloomberg's Jenny Marsh there. And let's get a quick look on these markets because we continue to see them move higher pre-market when it comes to the U.S. and certainly during the European trading session. Euro Stoxx 600 up 0.6%. Some of the outperforming sectors here are the DAX when it comes to Europe. Here is your U.S. picture as well. We're looking at S&P 500 futures up nearly 0.5%. Again, this comes off the back of already record gains. Driving that, you got earnings, you got Tesla, all of that really pushing us higher here. NASDAQ futures up 0.6%. We have more big tech earnings on deck. Certainly might help push these indexes up. But of course, how high is the benchmark? It's clear Facebook was able to beat that. It's rising about 2% pre-market. Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll be speaking to the CFO of Norsk Hydro as aluminum company becomes a net buyer of power. Later on, we discuss investing in sports with the chairman of Premier League side Leeds United, Andrea Ridazzani. Send us your questions, IB Plus TV Go.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones really for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Facebook rises in pre-market despite a torrent of bad news, but the stock gets a boost from a $50 billion buyback and a pickup in user growth. We'll bring you the latest analysis. Seeming progress in U.S.-China relations, Janet Yellen and Liu He address issues of concern, but 2 words from the Taiwanese president could derail the efforts. Plus, we discuss investing in sports. This hour, we'll be speaking to Premier League side Leeds United chairman Andrea Radazani. Send in your questions on IB plus TV Go. Good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. A quick look at your markets for you. We're looking at gains continuing after U.S. markets hit an all-time high. No sign that that gain will end anytime soon. At least a positive start to your European session here, about an hour and a half into cash markets trading, up about 0.5%. S&P 500 futures, though, underperforming that of NASDAQ futures. We do have big tech earnings. More of them are in deck after Facebook yesterday. So optimism heading into the likes of Google, Twitter, Microsoft. Finally, Brent crude just under $86 a barrel after yesterday WTI hitting the highest since 2014. Let's stick with our top earnings stories this morning. In the latest sign of how surging power prices are piling heavy pressure on the industry throughout Europe, Norsk Hydro has become a net buyer of spot electricity in the third quarter. This came as the company's hydropower operations slumped, but the Norwegian aluminum producer still reported EBITDA that beat the average analyst estimate, with rising metal prices largely offsetting energy costs. We're joined now by Norsk Hydro CFO Paul Kildemo. Paul, thanks so much for joining us. Good morning to you. Let's start with a question that you probably have had a million times, but you have a really strong market helping to propel your earnings. How long can that last?
Yeah, it's an extremely strong market, and we're probably seeing a tightness that we haven't experienced since, I would say, around 1987. And it's a combination of a lot of elements. You have short-term elements that you're referring to, power shortages, supply chain issues, strong rebound of demand after COVID. But we also have some long-term elements, like, for example, automotive requiring more aluminium into battery electrical vehicles. You're seeing the green transition requiring more aluminium to feed new windmills, etc. So the question is really, are the longer-term elements strong enough to balance out the short-term elements that could disappear? And I have no good answer to that, but the absolute strength of the market looks better than it did a year ago, also on a long-term basis.
Well, of course, it's hard to predict some of those long-term elements, but when it comes to the short-term things like the supply chain crunches, higher metal prices, do you have any readout or any predictions for how long those short-term elements, as you put it, will last?
Well, if you start, for example, with the chip shortage that we have experienced in our industry, which is now also starting to play a bit in on our side, then the expectation were that these would be resolved during the summer of this year. Now people are talking more about the second half next year. And on other areas also, for example, the energy side, it depends a lot on the weather conditions. Part of what we're seeing is driven by absolute long-term lower production levels of fossil fuels. Other things are driven by, for example, less rain in China compared to what they expected or what is the normal. If you have good hydrological seasons, you can see some of these elements improving, whereas other could be a bit more longer term in nature.
Well, things, for example, like in China, ingredients like silicone, magnesium, ones that are very crucial for your business in order to produce some of these specialized aluminum parts. Your CEO speaking earlier today said that he doesn't foresee that recovering, or that you have enough cover for that, rather, until early 2022. What happens after that period if indeed the market has not recovered, if China isn't able to step up some of their output? Do you have to look into alternative markets?
Well, that's a good question. If you start with magnesium, for example, 85% of the world's magnesium production sits in China. So there are limited other alternatives. If there are other alternatives, I'm quite sure that they are looking at the possibility for getting this out to market, given the extreme prices we're seeing now. We have strong relationships with the suppliers in China, and we see that there are developments, discussions about how to get this back. But if this does not come back, then basically for value-add products, you would, as a first instance, start producing more standard products instead, which doesn't require aluminium. But this is not a longer-term sustainable level. So then if China stops exporting, you would need to trigger production at other places.
And what does the conversation look like with your customers when it comes to some of these contracts? Obviously, demand is really high, but prices are high as well, especially with groups like the automotive groups. What have those conversations looked like?
Well, everyone is asking the same question that you are asking me now. What insight do we have? What can we guarantee? And we cannot guarantee more than we are working on it. And we're also needing to pass some of these costs on to customers. So there are many challenging discussions in a period where there is tightness across the value chain. But they understand that it's not a company-specific issue. This impacts all aluminium producers, and it also impacts many other industries which require more magnesium than aluminium. So everyone's working together across unions and organizations, etc., to try and make it very clear that this situation is not sustainable in the longer term for European and global industries.
Paul, before I let you go, I also want to ask you about Norsk Hydro becoming a net buyer of spot electricity. How difficult has this been, considering buying spot electricity in these markets hasn't exactly been a cheap venture to try to do?
No, we did buy buy electricity in the third quarter. On a whole year level, we are long power in most scenarios. But you might have quarters where we go a bit short because we try and produce electricity when prices are higher, which is typically the winter quarter. This doesn't create any large issues for us. We have a bit lower earnings due to that effect in energy. But on the other side, energy price differentials in Norway have been really high this quarter, which more than compensates this effect and actually results in an energy result, which is not too bad for the third quarter.
Paul, I'm afraid we're going to have to leave it there. Thanks so much for joining us this morning. That's Paul Kildemo, CFO of Norsk Hydro. Coming up, we're going to be speaking to the chairman of Leeds United Football Club, Andrea Radizani. We're going to ask him about the investment side of sports, as well as his thoughts on the recent takeover of Newcastle United. That's all next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
I'm strategically football in China. Absolutely. Who can't be, right? We know the country very well. We're very successful in the country, both on the onshore business and the offshore business. We have a very good combination of businesses in the wealth, IB, and asset management business, and we plan to invest more.
UBS CEO Ralph Hammers there speaking to Bloomberg. All right, now, though, let's change gears a bit and talk about soccer, or as most of our viewers probably call it, football, and one of England's most famous clubs, Leeds United. In its 102-year history, they have won 3 top division league titles and 1 FA Cup. During the late 60s and 70s, Leeds were one of the dominant sides in England with good runs in European competitions. In 2007, though, they entered administration and were relegated to the 3rd tier of English football. But after 16 years in the wilderness of the lower divisions, they triumphantly returned to the Premier League under the ownership of our next guest. Pleased to say we're joined now by Andrea Radazzani, chairman and owner of Leeds United Football Club and Azur Ventures. Andreas, thank you so much for joining. Really fantastic to have you on. So we definitely have to talk about the business of football and things when it comes to streaming rights in your venture as well. But I want to start off with some of the news over the past month, and certainly what's taken the soccer football business world by storm, is the Saudi takeover of Newcastle. I know in the past you've said money does not always equal success, but certainly it helps. Do there need to be something done to curb excess spending when it comes to Newcastle?
Good morning, Danny. Good morning, everybody. I think the rule allowed sovereign funds and government and state owned by funds to buy football teams. So I think everything is according to the rules. Obviously, having an unlimited budget enabled the club to have access to capital and buy all the players and make more mistakes than others. So I think it's true what I said, that football is played on the pitch, but when you have an unlimited budget, you can allow yourself to make more mistakes, eventually get it right over the time. So lucky the Newcastle fans that they will have a good journey over the next years, and they will attract good players in the stadium.
Well, it's not just Newcastle, right? We definitely have seen money in football growing. You have state-backed teams like Man City, PSG. How does Leeds United then stay competitive when you're faced with this type of money-rich environments?
Well, we are still far to reach a level of Champions League and this club with hundreds of million investment. So we have much more healthy management linked to the P&L of the club, but we are happy with our results. We have been growing very fast. I acquired the club 4 years ago with a 36 million pounds revenue, and this year we're hitting 200 million revenue. So I think the club has a steady, healthy growth, and we didn't inject hundreds of millions, but we are still growing, and I think over the next 2 years the club can get closer to the top 6 and hopefully try to reach European football with the project, with a sustainable project and quality of the players, and a good academy where we're investing a lot of resources to build our own and next future players.
You'll have to forgive my American bias here, Andrea, but usually when I think about football, unfortunately, I usually think of American football. I don't think I've been living here long enough to make the switch, but I know the San Francisco 49ers have a sizable stake of your club. What do American investors bring to the European clubs? Humor me here.
No, we are very happy to invite you at the road to experience our stadium, and you will fall in love with the club. I think it's something special. Last weekend was unbelievable. The atmosphere we had in our stadium is a very unique experience, and that's also what makes it different sometimes to other bigger clubs that maybe have more investment, more opportunities, but less legacy with the past, with the culture of English football. On the other side, I think we have a link with the American football. As you know, we are partnered with the 49ers. We have developed a fantastic relationship. We became very good friends, and besides being business partner. And I think both of our group, Azur Ventures and 49ers, are bringing to Leeds expertise, know-how in different fields, from media, content creation to merchandise and stadium management. So that's, I think, what is making very unique our ownership comparing to other clubs that you mentioned, even maybe with more resources, but we have a very deep knowledge and know-how in sport business, and that's what we do every day, 24/7.
Yeah, let's get a bit into sort of monetizing the business of sports because, of course, you have your venture, Acer Ventures, which looks at things like streaming rights. How much of the bull case for football streaming rights has to do with the platforms like Amazon, Apple bidding up to buy more football content?
Well, I think Amazon entering sports has been extremely important because they have access to hundreds of millions or billions of users. They have access to the retail, and they know everyone's habits and desire, wishes. So I think Amazon probably is the biggest platform that could be successful on sports rights distribution. And they started testing in some market. They entered with a few games in the UK. They entered in France this year, acquiring the 80% of the Ligue 1 games in France. So I expect Amazon to continue to go and build their offer on sports, but also there is space for a company like ours. In Acer, we have 11 sports, which is growing every year more and more. We are now in 8 different territories. We are strong in US, in Portugal, Belgium, Japan, Italy. And we continue to grow thanks to also the fact that we are approaching the sports very locally, and we find always local opportunity to serve our user for niche or premium content.
Of course, all of this comes off the back, Andrea, of a difficult time for football in terms of many clubs being hit by the pandemic, not bringing in a lot of that revenue. UEFA has their €2 billion loan fund. What do you make of it? Is it enough? Is this something that Leeds would like to try to tap?
Well, I was discussing within the league that many clubs every year, especially post-pandemic, they are accessing to financial resources with intermediate services. And we probably should organize a collective way to approach big institution like important bank to have a general collective agreement to reduce the cost that every year we have. I think a lot of value is football, particularly, is lost between intermediate for financial services or player agents. So I think we can have the clubs probably saving several millions for each club if we organize these two activities, particularly the financial services. Some of the league in Europe are already doing that, and UEFA as well is organizing that.
All right, Andrea, before I let you go, you got a big match tonight. You have Arsenal, you're taking them on. Tell me, what's your prediction for the match? How much is Leeds going to win by?
2-1, I don't know which way, probably I want to win. It will be a fun game.
All right, looking forward to it. I'm sure a lot of our viewers are as well. Andrea, really great to have you on this morning. Really appreciate your time. That's Andrea Radazzani, chairman and owner of Leeds United Football Club and Acer Ventures. Thanks again for joining us. Let's get now to your Bloomberg Business Flash. Here's Leanne Garins.
Hi, Danny. Facebook shares gained in late trade after reporting strong user growth in its social media apps and announcing a share buyback of as much as $50 billion. But in the earnings call, CEO Mark Zuckerberg flagged revenue headwinds stemming from Apple's restrictions on consumer data collection. He also called negative press around Facebook a coordinated effort to paint a false picture about the company. Now, Hertz, barely 4 months out of bankruptcy, has placed an order of 100,000 Teslas in a move to electrify its rental car fleet. Tesla's shares soared, pushing its value past $1 trillion for the first time. Hertz says the Model 3s will be delivered over 14 months for the US and parts of Europe, and is building a charging infrastructure to complement Tesla's superchargers. A study has found Bitcoin's ownership is still concentrated in just a few hands. According to research by the National Bureau of Economic Research, the top 10,000 individual investors in Bitcoin controlled about 1/3 of the cryptocurrency in circulation. The study also found the biggest 10% of miners controlled 90% of Bitcoin mining capacity. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. All right, coming up, how the world's leading cities for career women are failing them in several ways. We have the Bloomberg Big Take next. This is Bloomberg.
So if someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's take a look at some of the key events that we're going to be covering today. The virtual Bloomberg Equality Summit kicks off. We have speakers including CEOs of Dow Jones and Infosys. Our Manus Cranny is going to be hosting some of the conversations there. Then at 10 a.m. UK time, the Bundestag will be holding its first session since the German elections took place last month. In that meeting, there will be a vote for the Bundestag president and vice presidents. Later this afternoon, the earnings, they keep rolling on. We have some of the big tech giants with their third quarter earnings. It's going to be Alphabet, Microsoft, and Twitter. That's, of course, following Facebook's earnings yesterday. So we'll begin to have that clearer picture on how big tech has performed overall. Certainly, the reaction to Facebook has been a positive one, up about 2% pre-market. All right, it's now time for the big take. You can get to it by going NI Big Take Go on your terminal. And for the millions of working women in the world's leading cities, daily life is often shaped by what they cannot do and how they're excluded. A Bloomberg analysis of how 15 global cities rank for career women shows each failing in several ways. Joining us now is our Business Week editor, Rebecca Penty. Rebecca, so let's first start off with this index itself. How is it developed? What does it show us?
So this is an index that takes a look at the top global cities for business based on how they fare for equality for women. So we take into account things like safety, wealth, maternity provisions, mobility, equality, and rank these cities. And what we've found is that while there has been some progress, there are stubborn, unyielding changes that mean that women are left out of the top ranks of power in companies, in leadership positions, and therefore in society at large.
Yeah, one of the reasons this is so fascinating, because it's one of the first times that we've seen all of these cities together using very similar metrics. So how did the cities shape up in the ranking?
So Toronto came out at the top of the pack, but that's really not saying that much. It scored a 3.66 out of a possible 5. The rest of the cities fell in behind. Sao Paulo was at the bottom of the pack. Toronto, for example, was held back because of its lack of mobility. It has an old, aging subway system, so it's difficult for women to get to work.
And of course, I know the reporting for this took place over several months, and those months really marred by the pandemic. What has that impact been on the ranking, on gender equality in these cities?
So the pandemic had a leveling effect. Unfortunately, what it means is that everywhere women have been falling behind, and that's because women still bear the brunt of childcare. If they're also mothers, they've had to leave the workforce or step back in their careers, and also the types of jobs that have been most affected by the pandemic have largely been jobs that women occupy in greater numbers.
All right, so what did this teach us, finally, Rebecca, about what needs to be done for the cities that ranked low? What do they have to do to get up in these rankings?
Well, I think what we found is that in cities where, for example, safety is seen as a positive, as a plus, generally Asian cities like Tokyo, Seoul, Hong Kong, it's there where women are held back in managerial roles. In Japan, only 13% of management roles are women, and that's largely due to the fact that the maternity provisions aren't good. Fathers aren't encouraged to take paternity leave. So I think in the cities where they get things right in Europe, where there are positive maternity provisions, they lack on safety.
Rebecca, thank you so much for joining us. Such a fantastic story. Really recommend everyone go read it. That's our Rebecca Penty. All right, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kaylee Lyons join me. This is Bloomberg.
eye. When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
On one side, you see risk on. On the other side, you see the investor sentiment to be a little bit, careful around the inflation numbers.
The big question hanging over the outlook remains inflation in terms of how high it gets and how corrosive it really gets.
I actually think that, inflation will at some point decelerate next year. At some point, supply chain issues will go away.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kaylee Lyons.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, October 26th. Our top stories today. Investors look past the earnings report on Facebook. Shares rise on user growth and a new buyback. We'll hear after the bell from other big tech names, Alphabet, Microsoft, and Twitter. A surprise from UBS. The Swiss bank joins Wall Street rivals with a third quarter profit surge. And the Biden administration at home and overseas. The president's economic agenda picks up speed in the Senate. Meanwhile, the U.S. and China have what are called candid talks on trade and the economy. I'm Danny Berger in London alongside Matt Miller in Berlin and Kaylee Lyons in New York. Anna Edwards is off today. And Kaylee, it is all about big tech and big new records in these equity markets.
Yeah, that's certainly what's driving things here in the U.S., Danny. It seemed to lift sentiment in the Asian session overnight as well. Broadly higher for stocks on the day, though you did have Hong Kong and China down by a few tenths of 1%. And currencies and bonds were really quite mixed. But of course, in China, traders digesting that phone call between Treasury Secretary Janet Yellen and the Vice Premier Liu He about trade, about economics, what the implications are for the relationship in the world's two largest economies. But another story to pay attention to is in China is the crackdown on coal. Both Chinese regulators saying it may become one of those industries where they cramp down on excessive profits for coal miners. So that took the shares of Yangzhou Coal down about 8.3%. And also China saying that they may act to restrict movement in the prices of coal, really trying to rein in that energy crisis. And as a result, coal futures down another 5% today. They're down about 35% over the last 5 days. A better story, though, for another commodity, iron ore futures up about 3.3% in Singapore. And just pointing to the fact that there's no bid for the safe haven Japanese yen today, the biggest underperformer in Asian FX, weaker against the dollar by about 0.3%. Now here in the U.S., as Danny alluded to, it really is all about big tech. It was the NASDAQ 100 that led the way for U.S. equities yesterday. Thanks a lot to Tesla. May outperform again today. Thank you very much to Facebook after its results after the bell yesterday. NASDAQ 100 futures are up about 0.6%. Interesting action to pay attention to in the bond market. We retreat just a touch on the U.S. 10-year yield, down a basis point to 162. But pay attention to the break-evens, right around 266. That is the highest on the 10-year break-even, going all the way back to 2006. So inflation expectations are elevated. And finally, just a quick check on Bitcoin, Matt, just below $63,000, but still up about 0.5% on the morning.
So Bitcoin doing okay. Tesla worth over $1 trillion now, which is, I think, absolutely fascinating. Elon Musk was kind of questioning that on Twitter, but to me it makes sense when a rental car company like Hertz orders 100,000 cars from a company like Tesla. That's 20% of their annual sales. Let's take a look at what's going on in European markets. You can see green across the board here, with the exception of Portugal in Western Europe. But we have some pretty upbeat earnings stories, starting with Reckitt Benckiser. Reckitt makes some stuff that you probably know. Clearasil, they make Lysol, they make Woolite in your machine. So they make products that people use around the world. They're getting more expensive for Reckitt to make because raw materials costs are rising. But Reckitt says, don't worry, we're going to raise prices. And as a result, they're raising their sales forecast for the full year. So price increases, inflation coming through from Reckitt is actually going to help them in terms of their end-of-year sales. We have some down arrow stories here as well. Nordea, for example, is off. In Finland, Logitech is out after earnings that missed, and THG was devastated after a third quarter result, a third quarter update that RBC called underwhelming. But for the most part, Danny, things are very positive in Europe, and stocks continue to rise here.
Yeah, and when are they going to hit all-time new highs like that of the U.S.? It really is a bull market as we continue, though, to see inflationary fears, those so far not able to knock these equity markets off. Now, let's go ahead and take a look at what's ahead today. Speaking of earnings, we have tech earnings. They continue on with Twitter, Microsoft, and Alphabet reporting. We also have Robinhood reporting its third quarter results. Those happen at 5 p.m. New York time. Investors, they're going to be keeping a close eye on the company's outlook. We had cautious guidance during its second quarter earnings that sent the stock plunging by more than 10%. An FDA advisory panel also, they're going to be meeting on a move that could open up COVID vaccines to children as young as 5. And Canadian Prime Minister Justin Trudeau, he will be announcing his new cabinet after winning elections last month. We're also today keeping an eye on the New York City weather, considering that we've had flash flood warnings. Kaylee, you are there in New York. You are our resident New York weather correspondent, whether you like it or not. How rainy has the commute been?
I've always wanted to be a weather person, Danny. Honestly, at 2:30 a.m., my commute on the FDR wasn't horrible, but there was some standing water, and I would imagine that will get worse over the course of the morning, given that we could see an inch an hour of rain, according to some forecasts. Of course, also heavy winds. So if you're about to commute into the city, if you live in the tri-state area, just be careful out there. But let's get back to the markets now and take a look at Facebook. Shares gaining in pre-market trading after the company reported strong user growth in its social media apps and announced a share buyback of as much as $50 billion. But in the earnings call, CEO Mark Zuckerberg flagged revenue headwinds stemming from those Apple restrictions on consumer data protection.
As expected, we did experience revenue headwinds this quarter, including from Apple's changes that are not only negatively affecting our business, but millions of small businesses and what is already a difficult time for them in the economy.
Bloomberg's Tom McKenzie joins us now. So not all that positive on the top line story, Tom, but still, investors seem to like it.
Yeah, they did indeed. The key takeaways were that, as you say, revenues did miss, and a key part of that, in fact, the key part of that was these iOS changes. Interesting to hear Mark Zuckerberg trying to throw a line to the SME, saying that it's the small businesses that are hurting, not just us as well. In terms of user growth, though, and you flagged this, look, Instagram, WhatsApp doing very well for them, adding more users than the forecast expected. Then you had that $50 billion share buyback, that plan as well. What you had was the executives of Facebook really trying to shift the narrative as well around this drip of information that we've had about how they're dealing with some of these controversies to shift the narrative towards AR and VR. And one important line was that they're going to break out then from this quarter the results for the AR and VR division of that business as they try and build out what Zuckerberg describes as this metaverse. They're having a conference later this week. We'll get more details on that as well. Shares still up 20% year to date, despite all of these concerns about misinformation and how they deal as well with young users and the fact that user growth is starting to fall off as Bloomberg has been reporting.
They're up 20%, but they are not a $1 trillion company, but Tesla certainly is. Tom, I think we have this chart, GTV Go, on your terminal. For our radio listeners, we have a chart that basically shows Tesla market cap valuation just skyrocketing beyond that of Facebook. It happened earlier in the year as well. Tom, are we just disconnected from all fundamentals here?
I mean, even Elon Musk is questioning this, and he saw his own personal wealth gain $36 billion. We've been talking about the fact, who were the analysts who came out and they said, look, he's going to be the $1 trillion man at some point, and it's going to be driven by, in fact, what's happening with SpaceX. But it's Tesla that is driving his own net worth at this point. So a gain of $36 billion. It was this, as Matt was saying, this incredible order by Hertz, 100,000 cars, the biggest ever. And you had the sales of the Model 3 for last month, the top sales. That is the top selling model car, the Model 3, I should say, in Europe for that month, beating all of those incumbents. That's the first time that's ever happened for an electric vehicle. So the prospects still look pretty solid. Whether it justifies a valuation of $1 trillion, I'll leave that to someone else. The stock up 45% year to date for Tesla.
I gotta say, I cannot get over this story. I mean, first of all, Mark Fields at Hertz making a move like this. Secondly, making it with Tesla. And third, I mean, just the benefits to, if you're a car renter, you're gonna think, oh, let me just go to Hertz because I can get a cool new Tesla. And if you're Tesla, it's like allowing someone free test drives, not free, allowing someone to pay to test drive your car for days or weeks, which is so much better than just a 15-minute trip to the dealer. I just think it's very exciting. Tom, thanks so much for joining us. Tom McKenzie there covering tech for us. Now let's get to banks. UBS posted a surprise jump in profit as wealth management fees soared the most in almost 3 years. But the firm warned client activity is set to slow in the final months of the year. The CEO, Ralph Hammers, spoke to Bloomberg's Manus Cranny on inflation concerns.
On one side, you see risk on the other side, you see the investor sentiment to be a little bit, careful around the inflation numbers that are coming up, and they're seeking advice as to, okay, how do I best protect my wealth against upcoming inflation?
Let's get more with Manus now, who is live on the ground, I guess in an office in Zurich, but there for us, Manus. So what else did you hear from Ralph?
Lovely line. Strategically full bull on China. I'm just looking at a chart, and I'm just talking to the guys here behind me. I looked at this chart when he sat into his seat last year. We were trading just over 10 Swiss francs. We're trading 16.5. They've delivered a profit before tax, the best in 15 years. And the quarterly, as you say, is the best since 2015. The buybacks are there. When you look into these numbers and look under the hood, Matt, Kaylee, and Danny, it's about a monster investment bank, double the estimates at $837 million. Now, I suggest to everybody, shameless, ruthless plug. Go to Bloomberg.com, watch the whole interview. There's a whole chunk on what Ralph talks about in China. He's talking about a well-managed housing market, reorganized, no hard landing in China. And that's where they're working with clients to diversify their holdings from mainland China to a more international exposure. So wealth management, very solid return. Private investments, $26 billion. Yes, there's a little bit of people holding cash. Sentiment will come under a bit of pressure. But when I said, so the client's still, full risk on, he said, they're risk on. There's a qualification. They're risk on, just not full Monty risk on. So I think those are the takeaways for me. And certainly if I tie together HSBC and Ralph Hammers, they are unmoved on this hard landing narrative. There won't be a hard landing, according to both of them, in China.
All right, Bloomberg's Manus Craney, thank you so much. We love shameless plugs on this show, so everybody go check out that full interview. Let's head over to Washington, D.C. now, where Senate Democrats have moved closer to an agreement on President Biden's economic agenda. Biden sounding optimistic after a weekend meeting with Senator Joe Manchin and Majority Leader Chuck Schumer. Take a listen.
It went well.
Do you think you'll have a plan before Wednesday?
With the grace of God and the goodwill of neighbors.
Want to plan a deal by the time you leave for COP? Is that something you've expressed to Democrats?
That's my hope.
Senator Manchin, meanwhile, yesterday expressed optimism that there could be a deal this week. Joe Matthew, Bloomberg Washington correspondent, joins us now from our D.C. bureau. So, Joe, what Manchin actually said is, I think a framework should be feasible this week. So that does not mean something's going to be signed, sealed, delivered, and on the president's desk before he heads abroad at the end of the week.
Well, that's true. Far from, actually. There's still no bill to vote on, and it's not likely that one will emerge here in the next 48 hours. Framework is the word that they like to use here. A game of trust might be a better way to put it. Look, if things do come together with this reconciliation package, and it's still unclear what size it will be and what form it will take, Joe Manchin, as you mentioned, is still calling for $1.5 trillion. Democratic leaders are hoping to push that closer to $2 trillion. But what goes inside is the real story here, and there are still a lot of hang-ups with regard to climate provisions, proposed expansion of Medicare paid family leave. Joe Manchin does not see eye to eye with his Democratic colleagues on these, and without that framework, without that trust being struck between moderates and progressives, it's unlikely that the bipartisan infrastructure bill can get a vote. But that is the aim, that will happen, as you just heard from President Biden, before he heads off to Europe this weekend, so he can have something to show and a credible story to tell that Democrats can, frankly, get something done.
How is the relationship between the U.S. and China developing, Joe? We had Liu He, as Kaylee was saying earlier, speaking with Janet Yellen. I think it was their second call in 4 months, and China said the talks were pragmatic and candid.
Yeah, candid and constructive. Look, if it's a story that they're talking on the telephone for the second time in 4 months, it tells us a lot about where our relationship with China is. There was, frankly, no real progress that came out of this call. It was cordial. Everybody was honest. It's really building a foundation, Matt, for an actual summit, a virtual summit, but the first real meeting, the first conversation about issues between President Biden and Xi. They expect to do that at some point, but it hasn't happened yet, and more of this conversation could lead to an actual summit. The president today, by the way, will be virtually joining a summit of Southeast Asia countries from the White House as the administration starts to take a more international view ahead of the G20 and then, of course, COP26 next week.
And we know we'll have all of it covered with you, Joe. Thank you so much to Bloomberg's Joe Matthew. And of course, you can listen to Joe every weekday on his radio program, Sound On, at 5 p.m. Eastern Time on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. The big one to the upside is Bakkt. It's a cryptocurrency company spun off from Intercontinental Exchange, and yesterday it announced a services agreement with MasterCard and Fiserv. The shares were up 234% on that news yesterday, and in early hours this morning, up another 40% or so. Another mover to the upside is Coty Beauty. This is after an upgrade at Deutsche Bank. The analyst putting an $11 price target on the stock. It's trading at $8.27 this morning, up about 3.4%. And finally, in social media, of course, we were running through the Facebook results with Tom McKenzie. Those numbers are giving a lift to Twitter in pre-market trading. Maybe some of the user trends boding well for that social media company. It reports after the bell, and ahead of those numbers, it's up about 1.75% in early hours, Danny.
Wait, Cody, isn't that the company that owns some of the Kardashian makeup brands,
Kylie
Kaylee?
Cosmetics. Indeed.
Kylie Cosmetics. I had a feeling you might know. Well, that always helps to give them a little boost. No. We just, we wear a lot of makeup as, people around. All right, Kaylee, thank you so much for that. All right, coming up, we have Kathy Wood doubling down on deflation. We're going to dig into Woods' Twitter debate with Elon Musk. And the surge in inflation has forced longtime bond bull Stephen Major to raise his year-end yield forecast. Major joins us live this hour to share his outlook. Plus, the road to COP26 in Glasgow. We're going to be speaking exclusively with the European Commission Climate Chief, Frans Timmermans. This is Bloomberg.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
not
of our
rivals.
We know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Danny Berger in London and Kaylee Lines in New York. Anna Edwards is off today. Now, Kathy Wood is doubling down on her deflationary outlook. In a Twitter exchange with Elon Musk, the ARK Investments founder said new technologies will help bend the curve on inflation despite recent supply chain bottlenecks. You can see this, and I guess you could just go on Twitter and look up Kathy D. Wood. I'm sure you already follow Elon, like the rest of us. Eddie Vanderwalt joins us, Bloomberg MLive strategist, also a star of social media. Eddie, did you follow this inflation debate? I mean, clearly Kathy Wood and Elon Musk must get along quite well behind the scenes, but what do you think?
Oh, I'm sure. Look, this was lovely. I followed it in real time, yes. And look, I think that this is a classic case of miscommunication in Twitter, which will happen when you've got 280 characters, right, from time to time. Because I think they are just talking about different time frames. When you talk about what Kathy is talking about here, when she says, you know, we're looking at robotics, we're looking at genomics, we're looking at blockchain technology, AI, and even EVs, you know, these are long-term trends. And she's saying that, yes, in the long term, these are going to bend inflation lower because productivity is going to rise. And then Elon is turning around and saying, yes, but we are seeing inflation right now, right? We're seeing it today. We're seeing it in our supply chains. It is hitting us right now. Mm-hmm. So I think broadly, they are in agreement. They are both technologists. They both believe in technology's ability to shape the future, but they disagree, or they are just talking about different time frames.
Well, what's your take on this, Eddie? Because it's just we're sticking different things in front of inflation, deflation, hyperinflation, stagflation. Do any of them accurately describe the environment we're in?
Right. I think, you know what, it's such a hard thing to do right at the moment because we are going through an inflationary regime shift, whether that means that we are going to a high inflation environment or whether we are going to a stagflation environment. I think we just don't know. And it's been so long since we've gone through this regime shift because really we've had slow and stable, certainly as far as official measures are, for, 20, 30 years. Most people around today don't know any other environment. Most traders, certainly. So it's very hard to say, okay, well, what are the early signals? What do they tell us? And I think, I just don't think we know at this point. Certainly, I'm not buying the transitory part of the debate. I can tell you that much.
It certainly feels like an environment where our current vocabulary is just ill-equipped to describe what's going on. Eddie, so great to have you on, as always. That's our Eddie van der Walt of Bloomberg M Live. And of course, for more market analysis, check out M Live Go on your terminal. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But what that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. Do
you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Google is saying
saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Danny Berger in London and Matt Miller in Berlin. Now let's get the first word news, beginning with Hong Kong, which will soon end most of the quarantine exemptions for overseas and mainland travelers. The city is under pressure from Beijing to tighten what is already one of the world's strictest COVID containment programs. Hong Kong's goal is to eventually reopen the border with mainland China. A warning from Saudi Aramco. The CEO Ahmed Nasser tells Bloomberg that oil output capacity across the world is dropping quickly and companies need to invest more in production. He says that the supply deficit could get worse next year if the pandemic eases and more people fly. And Bitcoin's surging popularity hasn't changed one of its original attributes. Its ownership is still concentrated in just a few hands. According to the National Bureau of Economic Research, the top 10,000 individual investors in Bitcoin control about a third of the cryptocurrency in circulation. Researchers say that makes it susceptible to systemic risk. Coming up, he might not have thoughts on Bitcoin, but he definitely has thoughts on bonds. Stephen Major, HSBC Global Head of Fixed Income Research, joins us next. This is Bloomberg.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for example, even 5 years, I think.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller in Berlin and Kaylee Lyons in New York. Anna Edwards is off today. Matt, it's all about record gains in these equity markets. And at the risk of kicking off another Motors with Matt edition of this Tuesday, I mean, it's fascinating to see how much Tesla is contributing to this and how much that is contributing to Elon Musk's net worth.
Yes, well, first of all, Tesla is just such a huge company. Even before yesterday, it was already trading for $900 billion. Now it's $1 trillion company. So anytime it moves even a little bit, Tesla is going to move the needle on the S&P 500. Yesterday, we had a big move. It was up 12.6%. I mean, that is just absolutely massive. And I think, you know, the story behind it, Eric Schatzker had this great scoop. Hertz, with its interim CEO, Mark Fields, is going to buy 100,000 Tesla Model 3s. What an incredible order. That's like 20% of their annual sales. So, of course, it's great for the stock.
Yeah, and Kaylee, here's the stat I have for you. S&P 500 index moved 21 points yesterday. 11 of those points came from Tesla.
Yeah, big tech leading the way once again. It is a big earnings week for big tech, so I guess we should be glad it's going in that direction and not vice versa. Now, as for how the shape of the markets is looking right now at this hour, we are positive in Europe by about 0.5%, and it is big tech once again leading the way in U.S. futures, trading the NASDAQ 100 futures up by about 0.6%. Of course, we have more results due after the bell today. In the bond market, we are seeing yields coming in just a touch. We're down a basis point on the U.S. 10-year Treasury, just south of 162, and oil coming in as well. WTI down about 0.8%, but still right around that $83 a barrel level. As for some tech movers, Matt was talking about that monster move for Tesla yesterday. It is now a $1 trillion company. It is adding slightly to the gains in pre-market trading, up about 0.2%. Facebook is up 2.4% after its results. Yes, it missed on revenue, but a $50 billion buyback program and stronger user growth is what's aiding sentiment this morning. That in turn is lifting shares of Twitter up 1.7% before its report after the bell. We also have Microsoft due after the close, Matt, and it is higher by about 0.4% in early hours.
We'll be watching very closely as those big tech companies continue to report, Kaylee. I want to get, though, back to the bond market. I was reading a story by Tokyo-based reporter Finbar Flynn a couple of days ago, and I just thought the first line sounded like it could have come from a novel. He says global bond investors face an old enemy, inflation, and the universe of fixed income assets doesn't look to offer much in the way of shelter. I thought it was incredibly well written. He goes on to say U.S. treasuries, European sovereigns, UK gilts, etc., and so forth don't offer any protection. You're going to lose money on these investments. Let's talk to Stephen Major about it. No one better to discuss fixed income. He is the head of FI research at HSBC. Stephen, what do you think about the fact that, you know, if inflation is coming, there's nowhere for bond investors to hide?
I think you were right about that quote. It was quite beautifully written. But that's where it ends, really, because there's a great deal of assumption. The assumption is that the inflation rate that you see this month applies to the subsequent periods. Now, it may be for the next 1 or 2 months, but how can we be sure for the next year or the year after? So imagine if you had plus 5% in 1 year and -1 the next, then the average is 2% per year. And the thing with bonds is that they don't offer the same excitement as your Tesla stock or your Bitcoin or whatever you've been discussing earlier in the program. I'm sorry, they're not the same. They're there to give you some ballast in the portfolio, and they're there to compensate for the risk that plus 12% becomes -20 in a week's time. I mean, I don't know what's going to happen, but it seems to me highly volatile, highly uncertain. Now bonds have actually been fairly stable. I know that people are focusing on the fact that 10-year yields are near the top of the range, but if you look at 30-year yields, they're a long way lower than they were in March. And whilst it's true that the short-end yields have gone up, the long-end yields have gone down from the high, so Stephen, the curve has kind of pivoted.
Especially with what we've seen at the short end, do you think that move in the repricing of rate hike expectations has been overdone?
Well, every year for the last few decades, we see the market set up for rate hikes that may or may not come through. And normally the market is expecting too much tightening. There's these things called the spider plots that central banks use, and there's also the consensus forecast for 1 year ahead. It tends to be quite sticky, it tends to point upwards, and historically it's expected too much tightening. Now, maybe next year it could be right for once. I somehow doubt it, and I think a lot of this is risk premium, a lot of it is uncertainty. It doesn't mean to say it's going to happen.
Yeah, on that note, I have a viewer writing in who asks, Stephen, in a world where you can have China at sub 5% growth, how could we possibly expect hikes in 2022? I mean, if China disappoints like that, and a lot of people are starting to forecast Chinese growth will disappoint, is it possible for the Fed to move up?
Well, I appreciate the question, and the viewer is quite right. The view on rates for the US needs to be a global one. It needs to take account of what's happening in Europe, Japan, and China. It needs to also include the structural drivers, not just the cyclical ones. I'm talking about long-term drivers like debt, demographics, and wealth inequality, technology, etc. Now, the point of this is that China was growing at 20% year on year, close to in Q1, and in the third quarter it was below 5%. And so anyone who's suggesting that it could be below 5% next year is following the trend. It might be possible. It's not our forecast, but it's possible. The credit impulse has been pointing downwards for a while. So it could be that China has been leading the global cycle. They were certainly the first out of the pandemic in recovery, first ones with the inflation. Maybe they're the first ones with the disinflation next year. Who knows?
Well, to your point, Stephen, of bond markets not trading in a vacuum, considering the moves we've seen in the U.S. bond market, does it look overdone in places like Europe? Would you want to step in and buy bonds, for example?
Yeah, that's a really good point, because the European markets ahead of the ECB are pricing rate hikes next year. And the ECB's own economic forecasts don't have them tightening for about 3 years, maybe longer. So something is inconsistent there. So that gives the option to the ECB to push back against what the market's currently implying. And we have highlighted this in our recent publications, that maybe Europe is the place that you take some duration exposure, because fundamentally that's the least justified rate hike that's being priced in.
Speaking of your recent publications, you recently raised your year-end 10-year Treasury forecast for 2021 to 1.5%, up from 1%. But for 2022 year-end, you remain at 1%. What drives us back down there?
Yeah, well, just to give some context, the 2021 forecast is a matter of weeks away now. So that was really due to the passage of time and a mark-to-market. The 1% for the end 2022 was an unchanged forecast. So for me, that was just a small adjustment that we made to reflect the timing. I think it's very unlikely that the rate hike expectations are going to be delivered, and I expect at some stage in the first half of 2022 that we'll start to see evidence that the inflation isn't as sticky as people have been fearing, and maybe it starts to subside down towards the central bank targets towards the end of the year and into 2023. So that's the view.
That's interesting, Stephen, because we have someone writing in saying, look, with deglobalization, as a reaction to supply chains and a global ESG frenzy, doesn't that mean that inflation will be sticky, that it's not transitory?
Yeah, I mean, the points are well made, but there's a long list of drivers of the low rates, and we need to look at a weighted average of all of those drivers and determinants. and only when the weighted average is turning around do we change the view. So our view is based on long-run fundamentals. But point taken, there are some challenges to the view coming through, and those ones are valid. But I think that there are other factors that overwhelm them.
Stephen, so great to have you on this morning. Perhaps we need to get you in with Mr. Jack Dorsey and have a word with him about his call on Twitter for hyperinflation. Stephen, thanks so much. That's Stephen Major, HSBC Global Head of Fixed Income. Coming up next, we're going to talk about big tech with investor Mark Stockel of Adams Funds. And after that, Frans Timmermans, European Commission Climate Chief. All of those conversations to come. This is Bloomberg.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Over the last decade, as the audience that uses our apps has expanded so much and we focused on serving everyone, our services have gotten dialed to be the best for the most people who use them rather than specifically for young adults. And during this period, competition has also gotten a lot more intense, especially with Apple's iMessage growing in popularity, and more recently, the rise of TikTok, which is one of the most effective competitors that we have ever faced. So we are retooling our teams to make serving young adults their North Star.
Facebook CEO Mark Zuckerberg speaking on competition for young adults after the company reported third quarter results yesterday. Joining us now is Mark Stockel, Adams Funds CEO and Senior Portfolio Manager. His holdings include Facebook, Alphabet, Amazon, Apple, and Microsoft. So Mark, looking at Facebook's results, it was a miss on the top line, but you have that $50 billion share buyback, stronger user growth. Are you comfortable with your Facebook holding this morning?
We are, and I think one of the better ways to describe the quarter is it was good enough. I think there was a lot of fear, especially after what Snap said last week about IDFA on their business, but they gave us more disclosure, which I think is a very good thing, especially with all the money that they're spending. A $50 billion buyback, which never hurts. You never like to see a top line miss, but I think that was pretty well telegraphed with the issues that Facebook admitted on the iOS change. So we think longer term, this continues to be a very strong company.
If you're looking at it, if you take away any kind of ESG concerns, is regulation at all a problem for an investor in Facebook? Do you think that there is a threat?
I think the short answer is yes, but I think we have to keep some perspective. The first thing is that Facebook isn't the only social media company that has issues, but it's the biggest. Number two, Facebook, in some respects, has shot themselves in the foot. I think they should have done more up until this point. The Congress, unfortunately, has never really proven to be good at making changes or forcing companies to make changes. I do think, though, that the emphasis on young people has hit a nerve with a lot of people around the country. And I would be very surprised if we don't see more as it relates to protection of young people. Now, the most important part about that is, although young people are important to Facebook, they're not the only thing that drives what Facebook is doing. And I do think that they have the ability to do a better job of protecting young people while not significantly damaging their business.
I do wonder, Mark, to what degree some of that is already in the price. You look at a Facebook that has a forward earnings of about 19 times, 50 times for Snapchat. So it's already significantly trading at a lower valuation based on that. So is some of that already baked into the cake here?
It certainly is. And even the last, since I think it's the last month or so, it's down 14%, almost 14%. So there is some of that baked into it. I do think that there is a bit of a worry about what's going to happen with Congress, although I do think, as I said, we spent a lot of time trying to figure out, talking to advertisers, advertising agencies, what kind of changes with young adults or young people could you make and still have it be an effective tool. And that's where we derive a lot of comfort. They still need to make those changes, though.
Mark, widening it out beyond Facebook, as we mentioned at the top there, you own a lot of mega cap tech in your portfolio. Do you worry about those companies being vulnerable in an environment where yields are higher and there's been a shift more toward value?
I would say you should be worried about that if you're talking about companies that are have incredibly high valuations, sort of hair on fire valuations, and because if you're discounting those types of earnings, I think you're more apt to have big misses, or I'm sorry, have pressure on them. But I do think that the durability of the companies that we own, whether it's Facebook, Microsoft, Apple, these are durable companies with pretty predictable revenue and earnings streams. Unlike many of the, again, hair on fire NASDAQ tech stocks that get a lot of press because they're highly volatile. So I do think that there is a significant difference between durable companies like the companies I just mentioned and sort of the hair on fire tech companies that will probably end up feeling it a lot more than the durable companies.
Are there any of the big mega cap tech stocks that you want to stay away from? I notice you have FAMG, and there's no N there, it's just FAAMG.
We do own some Netflix, to be fair, to put that in there. No, I think if you're looking at tech and you're looking at companies' ability to deliver revenue and earnings, they are among the best. And there are a lot of other names that we don't own that I don't want to trash, so I'm not going to name them, that are, again, hair on fire, big PE, big expectation companies. And, our investors have come to expect sort of slow and steady from us. And we do think that within the tech realm, that the companies that you've mentioned that we own are relatively slow and steady, but durable and continuing to grow. And as was mentioned a minute ago, pretty cheap.
Right. Mark, thank you so much for joining us today. And I should say thank you for staying up so late or getting up so early for us. I know you're in LA where it's 2:45 a.m. We definitely appreciate it. Getting your morning started very early. Mark Stockel there, Adams Fund CEO and Senior Portfolio Manager. Thank you so much for joining us. Now, the EU's top climate official is set to meet China's special envoy on climate change in London on Wednesday. The two sides are attempting to build momentum ahead of COP26, which starts later this week. Let's get more with Bloomberg's Maria Tadeo, who joins us from Brussels with a special guest. Maria?
Yeah, and he's here, the EU's top climate official. He's joining me here, Frank Timmermans. By the way, you're the first guest to have in our new Brussels studio. I'm very thrilled.
It's beautiful.
You like it?
Yeah.
You said you like the orange, right?
Absolutely. The orange is top.
That's good. And of course, you know, going now into the substance, you know that there's COP happening in just a matter of days. I know you're meeting with the Chinese delegation tomorrow. What are you hoping comes out of the meeting with the Chinese tomorrow?
Well, I hope we can get some idea of their heightened ambition. They say they want to be more ambitious. I hope I can get a clear idea of when they think they can peak out their emissions, so when they reach the highest level of emissions and then go down after that. And I want to hear from them how they see the COP process going on now, how they see the G20 happening and what we need to do to create a success at COP in the next couple of weeks.
And with regards to the Chinese, you know, it's very public now that they've said we want to be also more engaged on climate. But by the same token, the Chinese government has also said when it comes to coal this year, we're going all out. We don't want anyone in China to have a rough winter. President Xi is very now conscious about what he says is almost person-driven recovery in China. This is very ideological. Can the two of them come together and say we're going all out for coal and we also want to be climate neutral? Do you trust them?
Well, I think we all know that there's no future in coal. In the immediate, they might need coal to keep people warm in winter. But in the mid and long term, we all know that coal has no future. So exiting out of coal is going to be one of our main tasks in the next years. We will set the example in the European Union to show that you can do this in a way that is just, that you offer a real opportunity for a better future for the coal mining regions, that you keep everybody employed, all the coal miners in new jobs. We want to show that and then share that experience. I was traveling in Asia last week. Asian countries such as Indonesia and India are very much interested to work with us to share the best experiences in that transition.
And I know that this is something that is very close to your heart. I mean, you've made your life now about climate and getting there. So I wonder, are you disappointed, however, that in Europe, you know, we're talking about this energy crisis, again, this idea of whether or not we should use nuclear energy as to build from this transition from fossil into green? Is that something that you feel it wasn't the right time to bring up again this debate, especially going into COP?
Well, frankly, I believe that if there's such an energy crunch, I mean, these prices are soaring. All politicians with national responsibility are nervous because they don't want their citizens to suffer. And I have full understanding for that. But we need to make sure we don't throw away the baby with the bathwater. Transition to renewable energy is the best answer to this crisis, because had we done that 5 years earlier, we would not be in the situation that we would need so much natural gas, that we would be seeing these soaring prices. So the faster we transit to renewable energy, the faster we are independent of these high prices.
And just to make it very clear for investors that are watching this, when it comes to the targets that you've put on the table, the 50-55, and everything that you've said will be our investment plan in the future, you're not going to backtrack on anything. That's not set in stone.
Absolutely not. We need that investment to happen. By the way, the investment community is interested in this. I think the interest, if you've seen the last couple of years, greening their investment portfolio is sort of the top priority of all investors. So I'm quite upbeat about that. I think we have a huge opportunity to show to the world community that the European Union is capable of doing this, and also doing it in a just way, in a socially acceptable way.
And the targets, that stays on. The 50-55, the agenda that you've set out, that's not going to change. It really is, because there's been talk that perhaps it's too much, it's too fast, and this shows that it's also very expensive to transition. That stays as it is.
Well, first of all, it's much more expensive not to transition. Just have a look at the floods we've seen, the tornadoes. The cost of that, if that happens on a yearly basis, is enormous. So not transiting is even more costly. Secondly, it's the law. We've set this into law. The climate goal of being climate neutral in 2050, of reducing our emissions with at least 55% by 2030, is legally binding on all member states.
And, you know, going back to Europe, we've seen a number of countries, particularly the Polish government. We know that right now there's a very contentious legal issue that is happening too. It's been floated that perhaps they could try to block or potentially even veto some of this legislation. Just to make it clear, is that going to happen? Could that derail any of your big projects?
I don't think so. I think we have a compelling proposal, especially for countries that need help in transiting, such as Poland. I mean, what sort of a threat is it to say, you know, if you don't do what I want, I'll shoot myself in my own feet with a shotgun? I mean, that's not a threat that I find credible. Poland is the first country that can profit enormously from support from the Just Transition Fund, from all the money that will be flowing that way. So I think, you know, everybody knows in every coal mining region in Poland that they need support to exit out of coal, and they need it now.
And we've talked about China, we talked about Poland, and now, of course, we have to talk about the Biden administration. What is the vibe going into this meeting? And then the reason why I ask you this, the last time there was a big event like this, it was a G7 in the UK, and we know what came out of it was a submarine deal that really annoyed the European Union. So I wonder, on the surface, it does look like you're on the same line, but I wonder, behind the scenes, are you going to get the same level of ambition that you want to see?
Yes, I think so. I think the Biden administration has been very clear. John Kerry's done a tremendous job. And we're working with them hand in hand, like with our other partners, to make sure that Glasgow is a success.
And, we'll see you very soon there, hopefully in person. Get some sleep because you're going to need it. Well, thank you so much, Fran Timmermans. Thanks so much for joining us. Kaylee?
All right, Bloomberg's Maria Tadeo with Frans Timmermans, EU Commission First Vice President and Climate Chief. Thank you so much. We are all looking forward to the start of COP26 in 5 days' time on October 31st. But here's a look at what we're watching today on October 26th. First of all, guys, I know I'm being a weather person today. I am watching the nor'easter hitting New York and the tri-state area. We have flash flood warnings. We have states of emergency declared in New York and New Jersey. We could see up to 1 inch of rain per hour at some points in the day. So if you're just starting your day, heading out to commute, be careful on the roads out there, Matt. I know you don't have to worry about that so much in Berlin.
Soon enough, I will be back in New York driving around in my gigantic pickup truck, so I won't be worried about anything. I'm watching the Conference Board's consumer confidence numbers. They're coming out today, and this has been a real concern. In fact, Danny Blanchflower from Dartmouth recently wrote a paper saying you don't see drops in consumer confidence like this without a recession following closely on the heels. And more we're hearing about that. It's not the consensus view, but there are some voices out there, some bears out there calling for a recession, and they're watching consumer confidence very closely.
Yeah, really interesting one. Matt, I'm watching Microsoft and Google, perhaps where you would hide if you are concerned about consumer confidence. We've seen a big run up in tech. Google shares up 55% today. Will the earnings deliver? It certainly is a high bar. So that will happen later today in the U.S. After the U.S. session. We have more Bloomberg surveillance ahead. We're going to hear from Johns Hopkins. We're also going to hear from J.P. Morgan, among others. Smart conversations to come on all things markets. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
So if someone wants a leader
is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
And the Fed are increasingly open to the prospect of perhaps a quicker hiking and tightening cycle.
The market has repriced the hiking cycle significantly.
The market's been very quick to price out interest rate hikes by the Fed in the middle of next year.
From a Fed's perspective, the fact that the terminal rate is not rising gives them less room to hike.
We don't think that they'll actually be raising rates until 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
All-time highs coming into Tuesday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up another 19 on the S&P, advancing 0.4%. Tom Keene, we had the drawdown. It didn't last long. This is what you're calling the draw up?
Well, I've been calling it the draw up, looking at the traditional definition, but the draw up from the beginning of the pandemic. John, this is really, really important. I've never done this in my career. I'm taking earnings comparisons back pre-pandemic, basing off 2019. So if you look at the draw up from the beginning, before the pandemic, the Dow up 22% off the good news of early February of 2020. SPX up 35%, NASDAQ up 60%. And the answer is forget about 2020, and the market seems to be doing that this morning.
This market has ripped back, Tom Keene. The NASDAQ included 1% away from that high in September 7th. Let's talk about Tesla. Can we say congratulations, Elon Musk? Tom Keene, a $4.2 billion deal adds $120 billion to the market cap of Tesla. We have a $1 trillion stock, Tom.
All the media is looking at Eric Schatzker breaking that story yesterday on it, and it's a different Tesla this morning than maybe a week or 2 weeks ago. John, it has log convexity. That's fancy talk for acceleration. It was accelerative yesterday, up over that $1 trillion statistic. I mean, just absolutely just stunning.
Lisa, you've got to love Elon Musk. Strange that moved the valuation, as Tesla is very much a production ramp problem, not a demand problem. The words of Elon Musk.
Elon Musk about to become almost twice as rich as the next richest person in the world. I just want to note the fact that he might become the world's first $1 trillion man. Look, people pointing to the fact that Tesla still has a junk rating. My question is, what does this indicate? That we're looking at companies that have gotten ahead of their skis in terms of valuation, or that frankly everybody else is behind the curve and trying to figure out what these companies are? Is it a car company?
Well, we know what UPS is. Tom Keene, that stock's up 2.5%. The earnings come in. It's a beat and a raise into year end for UPS. Adjusted EPS coming at 271. Tom, the estimate 254. So a nice beat for them. The stock's up 2.5%.
Out of Atlanta, they're rooting for the Braves against the Astros. And John, it's real simple. I do care what UPS and FedEx do. They permeate the American economy, maybe somewhat like Amazon as well. And I see guidance there up, and that's the tone you see in the tape this morning.
Beat and raise, much more still to come this morning on the earnings front. Here's the price action for you as we kick things off this morning. Equity futures up 19, advancing 0.4%. Yields in about a basis point to 161.85. TK, what was Kit Duke saying about euro dollar? 116.18.
Well, it's range bound, and this is something we've talked about. It's something we've struggled with, and you've got the equity dance going on, and there's some interesting in the yields. Crescenzi coming up here. Must listen for Global Wall Street in a moment. But a lot of some other stuff just stuck in the water. And Kit's looking back to 1999, not synthetic euro, but back to the advent of the euro. And the euro's done nothing for a brief moment here, like it's never done nothing before.
President Lagarde coming up on Thursday. Lisa, that ECB decision a couple of days away.
Yeah, interesting to see what the ramifications are in markets where the yield curve flattening has a lot of people's attention. Today, I think is going to be fascinating when it comes to economic data. We get two sides of the same coin. How much are higher prices dampening consumer confidence? At 10 a.m., we get U.S. September new home sales. An hour before that, 9 a.m., we get the idea of how much housing prices have been going up. The expectation is for it to be 20% year over year, although a deceleration in the pace of increases. How much does this dampen appetite for homes? And then also at 10 a.m. we get consumer confidence, the latest reading. How much is consumer confidence coming down? The expectation is for just a little bit of a dampening, but really the story of earnings has been that dampening consumer confidence has not bled into any kind of slowdown in revenues. Then today, an FDA panel is meeting to discuss vaccinations for 5 to 11-year-olds. I know I'm watching this very closely. Tom Keen's watching this very closely. We all want to know when our kids can actually be inoculated. Meanwhile, frankly, the interesting thing to me is that the pickup in terms of who's getting vaccinated goes up as far as a proportion of the overall population as people get older. How much of a pickup can you get in the 5 to 11 set, even after we have a vaccine out there? And then aftermarket, Alphabet, Microsoft, and Twitter all reporting. Interesting to see the diverging stories. How much is it a cloud story when it comes to Microsoft, when it comes to Google, where shares have just been on a tear? I mean, we talked about Microsoft and how much shares are up there, but Google shares, Alphabet shares up 58% year to date. How much is this a tech story, and how much is this a cloud adoption story, and how much does that diverge from the social media giants and Twitter?
Just call it Google, Lisa. We all call it.
I knew you were going to call me out on that.
I know. It's okay. Tom does too.
You know, what are they going to do with Facebook? What's the name of Facebook?
Well, keep calling it Facebook, whatever they call it, Tom.
Mirage.
Mirage, okay.
Moving on.
Facebook. No, let's not do Facebook. Tom, Microsoft. The quiet rally in Microsoft, up almost 40% this year. It's something year to date.
Yeah, it is. And Microsoft's there. Joe Feldman publishes definitively on Amazon this morning, John, as Lisa mentions, the cloud as well. He's staying with cloud growth at Amazon. Did you notice, John, I'm going to say this as an amateur, the British Secret Service or whatever decided to go Amazon cloud, a bit of an uproar in the UK. I missed that one, Tom.
Yeah. I missed that one. When you begin a sentence with a little bit of an amateur, it doesn't bring you much credibility for what you're about to say.
Well, I'm just trying to be honest. I mean, what do I know about
I appreciate the honesty.
What I like about Feldman is he's got EBITDA margin 16.7%, and UPS, United Postal Service, just comes out and they raise their operating margin, John, to 13%.
Beating a raise, the stock likes it, Tom. Likes it. Tony Crescenzi joining us now, market strategist and portfolio manager at PIMCO. Tony, this cycle is moving so quickly. That's the story, the epicenter of your outlook with you and the team right now. Can you just walk us through how you're thinking about the world around us at the moment?
Well, we when we like to talk about the yield curve, and the yield curve movement speaks to this idea of a fast-moving cycle. It does seem like the economic cycle is moving at warp speed. Think about it. We're probably at mid-cycle, meaning look at the unemployment rate, 4.8%. What is a late cycle condition? Of course, an unemployment rate that's lower, and that lower rate could be achieved, full employment, next year. So that's a fast-moving cycle. In fact, the Federal Reserve is projecting that the unemployment rate will be in the mid-threes by the end of next year. So for investors, it's important to be on your toes. It's a simple way of saying it's important to be active with portfolio management, to be thinking more about security selection, regional selections, et cetera, et cetera. And it is a fast-moving cycle. One final note, that the yield curve, again, it has flattened recently, and that's something that happens later in a cycle because the Federal Reserve is raising the short-term rate, which pushes up its yield relative to the long-term rate, flattening the curve.
Tony, that's where I want to go. 210 spread this morning, 118 basis points. Tony, where is the two-year yield that matters to you? We're at 0.44%. Just in your mind, Tony, where's the two-year yield a tip point or a critical point for Crescenzi?
Well, the two-year relative to other yields matters a lot. I mean, it's just that the two-year will tell us about the two-year window. And we know that the market's looking at shorter-term interest rates and forward interest rates like Eurodollar futures is projecting that the Federal Reserve will increase its policy rate sometime next year, perhaps as early as June. The market's penning in several interest rate hikes. But there's two extraordinary things about the two-year to 10-year spread. One is the fact that the spread started to flatten earlier in the cycle than we have seen since the 1980s. And then in the last three cycles, the last three recessions, the spread between the 2 and the 10-year note was as wide as 300 basis points. In other words, the markets were patient about the idea of Federal Reserve interest rate hikes. It thought that interest rate hikes were somewhere out in the distant horizon. And so long-term yields had stayed high. But now, so this is the peak this time was 150. So it was half the level of the previous cycles, is to cut to chase. The second part of the extraordinary part about the yield curve 2-cent spread is that the 10-year yield is projected to be low. And on Bloomberg, a function for you Bloomberg users, FWCM, it shows forward interest rates, and you see the market is saying that there's a benign story to evolve, unfold over time, that interest rates probably won't get above 2.5%, even as far out in these forwards as I look at the table, calling it 10 years plus.
Well, but Tony, just to sort of tie this all together, then what is the message from the yield curve? Is it that the market, that the economy can't necessarily handle too much tightening from central banks? Or is it just that the margin is going to naturally be narrower because of this ceiling on longer term yields?
Lisa, those are probably the conclusions that most would draw from it now. But perhaps forward interest rates are wrong. Perhaps the market, the consensus, and that's embedded in these forward rates, is wrong in thinking that the 2010s it will be repeated in the 2020s. But the 2010s is probably the wrong analog for the 2020s. There's a lot going on. In PIMCO's secular outlook, we speak to transformations, for example, becoming more digital, more inclusive, more green. Those are the three major transformations we see. All of those things could, we're not saying they will, result in faster growth. And simply doing the math, if economic growth is 4% as the Fed projects next year, and PIMCO projects as well, then looking at the next 5 years, even if growth is 2% in the subsequent 4, we'll still have a rate that's about 2.5. So that would be a lot better than the 2010s simply just by that math. And so it's possible the growth is faster, and these forwards are wrong, and therefore rates will go higher. We're not suggesting that rates will go materially higher. In fact, we would say we may return to certain old normal conditions, but with new neutral characteristics, which is to say that, yes, Lisa, that the Federal Reserve can't raise its interest rate too much because of debt loads and certain other factors.
Hey, Tony, we're out of time. Haven't even got the time to plug your book. Got to let you go. Tony Crescenzi there.
Thanks, John.
Hey, Tony, thank you. Good to catch up, as always. Bit of news out of China, Tom. There is a developer in China you might have heard of called China Evergrande. China's urging the founder to pay the debt with personal wealth, asking some firms, Tom, to prepare for offshore bond payments.
It's a different formula.
You think?
I don't know what to make about it.
I think it reads... That's how you make of it, Tom, just as it reads.
I don't...
All right, okay, you don't want to go there. Feel that. Tom Keane, Lisa Bramett, Jonathan Farrow from New York City this morning. Futures up 19. Care to comment? No, up 0.4%. Still don't care to comment. Okay, from New York. I'm sure you'll jump in right at the end now, just as I'm going.
What's the Dow doing?
Okay, this is Bloomberg.
With the First Word News, I'm Laura Wright. The US and Chinese governments have made some incremental progress in their economic and trade negotiations. Treasury Secretary Janet Yellen and China's Vice Premier Liu He held their second call in around 4 months. Beijing described the conversation as pragmatic, candid, and constructive. China has repeatedly said the US should lift tariffs on Chinese exports imposed during the Trump administration. Senate Democrats have moved closer to an agreement on President Biden's economic agenda. Senator Joe Manchin expressed optimism there could be a deal this week. He's been pushing to shrink the size of the social spending package. Still, some House lawmakers raised doubts about the terms of the deal being discussed. Hong Kong will soon end most of the quarantine exemptions for overseas and mainland travelers. The city is under pressure from the Chinese government to tighten up what is already one of the world's strictest coronavirus containment programs. Hong Kong's goal is to eventually reopen the border with mainland China. In the UK, Chancellor of the Exchequer Rishi Sunak will end the pay freeze on public sector jobs. Sunak will make the announcement in his budget tomorrow. The pay freeze took effect for 2 million workers in April. The Treasury cites what it calls the strong economic recovery as a reason to raise salaries. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
essa população é uma população importante, é uma população que frequenta a escola também, né? Então, é importante que eles também estejam protegidos para o coronavírus, evitando essa transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal.
Foi toda administrada.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Went well. A few more things to work out, but it went well.
Do you think you'll have a plan before Wednesday?
With the grace of God and the goodwill of neighbors.
Do you want to plan a deal by the time you leave for COP? Is that something you've expressed to Democrats?
That's my hope.
A lot of hope in the past 24 hours. From New York City, that was the President of the United States. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. This Tuesday morning, all-time highs coming into Tuesday. Equity futures up 19. We add some weight to the recent rally, up 0.4%. The Nasdaq gapping aggressively lower from September 7th, and then eating its way all the way back, Tom, to within 1% of a record itself. And the FX market, euro-dollar 116.16, and crude pulls back, TK. We're down 0.4%, $83 and about 40 cents.
You really reaffirmed, John, we are really going into the heart of this tech earnings stream today. And I don't think, John, we expected earnings from non-tech companies to be this buoyant. I just think we're not where we thought we would be right now.
The likes of UPS doing pretty nicely this morning, Tom. And within sectors, winners and losers. We saw Unilever raising prices, passing them on to the consumer. We saw Kimberly-Clark struggling, Tom, with costs.
And again,
there's a story of different winners, different losers, as you might expect any earnings season, Tom. But it hasn't been that broad story where the whole market gets dragged down.
Yeah, Liz Ann Saunders with a brilliant tweet on that overnight on the beneath the market. There's some really interesting dynamics. Beneath the politics of this nation, there are some really interesting dynamics as well. Joe Matthew, now our Bloomberg Washington correspondent. The president can waltz out. He can have a televised moment, Joe, and say, let's get it done. Who is doing the let's getting it done as we try to get it done this morning in the white marble of Washington?
Well, it's the leadership, really, and I say that, Tom, because we've been talking to lawmakers every day here in the Washington Bureau. I do on my program, and I speak with, in many cases, sources close to committees that matter. Think the Rules Committee, for instance. They don't know what's coming next year. They're waiting for cues from Nancy Pelosi, from Chuck Schumer, and they are waiting for cues from this White House. And, of course, all roads lead to the gentleman from West Virginia who we're still talking about here. You've got the president saying, by the grace of God and the goodwill of the neighbors. I'm wondering if Joe Manchin should be the one going to COP26 next week, because as these climate provisions slowly leak out of the plan, it's unclear what the president will be able to show for it.
And, John, the chemistry of this is really serious, John. I mean, it gets right down to methane. Did you notice, John, how Matthew got his show plug in the second sentence?
I did, and we'll do that again at the end. Joe, we will get there. Don't worry. You don't have to do it yourself. We do it at the end of the conversation. We do a nice graphic as well on TV.
It's my baseline, guys. What can I say?
We do
It's
a
where I
graphic
talk.
Joe,
on
it
radio.
seems to me that down in Washington, the president is negotiating with one man, Senator Manchin. That's not news. We're all familiar with it. Is he negotiating something that will actually pass this House? Because that's what confuses me at the moment.
Well, same here, and it's really unclear. We're still talking about the same 10% that's been left over, where it's paid family leave, right? Proposed expansion of Medicare and climate, and we've really been focusing on climate in advance of COP26. I think I heard Tom mention methane. That's the latest one. You got the clean utility component out. Joe Manchin also opposing a fee on methane emissions. So is Joe Biden going to go to Europe and talk about incentives for EVs, that's the centerpiece of the progressive Democrat approach to climate change? They were hoping to have a heck of a lot more than that. And as we look down for the next several days, it's possible you get a vote on the bipartisan infrastructure bill. By the way, that had incentives for EVs. They didn't have to knock their heads together for 6 months over this reconciliation bill to get that. So President Biden could be wondering as he gets on that airplane exactly what he has to show for it, other than credibility. Maybe that's what this is, competency, credibility. Look, guys, we got something done. And while he's showing off what got done for world leaders, it will resonate here. I just want to remind everybody that 1 week from today is an election day, and it's an awfully important one around here in Washington, D.C., with this gubernatorial election next door in Virginia.
Okay, so what's enough to get the physical infrastructure bill over the finish line? I mean, this really seems to be the key issue. What counts as an outline for the human infrastructure plan, enough to get finally something actually passed that everyone agrees on in Washington?
It's a great question. I'm not sure anyone really has the answer to it. How long should the paid family leave be? What's the duration of the child tax credit? And will there be an expansion of Medicare that Joe Manchin can accept and doesn't believe will leave the rest of Medicare insolvent in a couple of years? Those questions have been unanswered. We have seen progressive Democrats continue to dig in. Pramila Jayapal, the chair of the Democratic Progressive Caucus in the House, is already saying, next week, maybe we'll vote next week. How many weeks can we do this? I've been talking to you guys for months every week about this, and it seems like it always gets right up to the edge, and then we delay things for another week, and that could happen again.
You and I were weaned on the realities of one Tip O'Neill. I would suggest that Mr. O'Neill never overreached. What's the Matthew overreach gauge right now? Is this a Democratic Party massively overreaching?
It will look like that until something is done. I just would remind Tom and everyone, $1.2 trillion on infrastructure. Let's say they get 1.75, maybe just shy of $2 trillion on reconciliation. The Democrats will have $3 trillion in new spending, programs that never existed before, and get it all done before the end of the year. That may sound like an overreach to you, but it would be a huge victory for Democrats, just as we're planning for this whole thing to fall apart again. Remember as well, it took Obamacare 9 months to get done. So this could last a little bit longer.
It's a good point, Joe. Here it is. Drum roll. You can catch Joe on Sound On.
All right. Nice.
On Bloomberg Radio. Weekdays at 5 p.m. Eastern Time. Can you tell which bits of this show are scripted, Tom?
Yeah, you
Joe,
can.
thank you, sir. Joe Matthew down in D.C. Joe, we appreciate it. Tom, the optimism of the last 24 hours, is it warranted in your mind?
Yeah, well, I mean, the optimism in Washington, I
Around
don't know.
getting something done.
I don't buy it for a minute. You know, they'll come up with some form of decision, and Glasgow seems problematic, as we heard from Prime Minister Johnson yesterday. John, on GE earnings coming out, you know, I'm going through the PowerPoint right now, and again, they're raising a margin view, but on flat revenue growth. This needs more study.
Make it very simple, Tom. What they see now is better than what they saw previously.
Yeah.
Fair to say? Working through the
it's a
supply
work
side
in progress.
disruptions, a work in progress, and Lisa, what they see now is better than what they saw previously.
This, to me, has been the underlying story, even as we see supply chain issues and, frankly, labor market shortages. The idea that the optimism still is the prevailing sentiment, and that is the story also with General Electric.
Rock solid, resilient optimism in this equity market, Lisa. You just can't beat
it's
it down.
It's not rock solid. I mean, honestly,
is it not?
They're
All-time
questions.
highs. You
They're
just
all-time
can't.
highs,
You
but they're
can't bring it
questions
down.
still. No, you can't bring it down.
You just can't. It's a struggle. I'm with you. It's fragile. It's an uncomfortable all-time high.
It's an
uncomfortable confidence.
Guys,
good. I like
does that work? Is that better?
Lisa, you're driving me nuts. Come on. Year to date,
I'm calling Dr.
NASDAQ
Phil.
up 18%, SPX up 22%, Dow Jones up 17%. It's just not rock solid.
Okay, fine. You can mock it on the headline numbers, but if you look under the cover, there are winners and there are losers, and there have been some significant laggards, and that's interesting. And I see you covering your face. I still think it's interesting and important to point out.
It's been tough out there if you've not been long this equity market.
Well, yeah.
Although Tom's not been long either, so I mean, who knows? Don't you need to do a role reverse?
I'm looking for an entry point.
Futures up 0.4% this Tuesday morning. Good morning to you all. All-time highs in the equity market. A ton of earnings through the week. Looking forward to covering them with you. From New York, this is Bloomberg. from New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
All-time highs into Tuesday from New York City this morning. Good morning. Equity futures up another 18, advancing 0.4% on the Nasdaq 100. We gapped lower from September 7th. Then we gapped higher. We're 1% away from taking out that September 7th high. In a Russell, the small caps, they advanced a third of 1%. That's the equity picture. Ton of earnings through the week. Big tech after the close. What do we got? Microsoft. Got Google as well. Switch up the board and get to Tesla and get to Facebook. Congratulations, Elon Musk. Intraday, this is not pre-market here, this is intraday yesterday, up 12.66% on Tesla. What a move off the back of a $4.2 billion deal, Tom. What a move. A $1 trillion company now. $4.2 billion deals at over $100 billion in market cap. Tom, as Lisa pointed out, and we've talked about several times, we have a junk-rated credit with a $1 trillion market cap in the equity market.
And they got to go out and build the stuff as well and think of the competitors that will come in. That's all the doom and gloom. The reality is everybody's on board. As I said, it was accelerative yesterday, John.
That's the Tesla story at the close yesterday.
Yeah.
Here's a story right now in the bond market, 2s, 10s and 30s. 10s right now 162.38. Highs of the year we're pushing 180. End of March at about 177. At that point, the 5s, 30s curve was around 160 basis points. Right now, Tom, it's about 80, 90 basis points, and that's the change. Yields might have picked up on 10s, pushing out where we were in the first quarter at the back end of March this year, Tom, but the curve's gone the other way because of that lift at the front end and through the belly. We're talking about rate hikes now in a way we weren't at the start of the year, and that's the difference.
Yeah, Crescenzi was brilliant on that, and John, I'm just noticing it for the first time because I usually ignore the real yield, but negative 1.04. I mean, that's going the wrong way for the optimists.
The recent move, Tom, all about inflation. Right now, 30s, 2.07%. You usually ignore me too. Down on the long end, Tom, by about a basis point on 30s this morning. Back to you.
Thank you, John.
Anytime.
Good. Lisa, you want to jump in here?
No, I think that you guys have done a great job.
We've done a great job.
Let's go to Andrew.
Warming up the morning. Andrew Sliman joins us right now, Senior Portfolio Manager at Morgan Stanley. Andrew, I love this idea of watch the internals. That's jargon. What are internals to a guy like you?
Well, look, this summer we had this, kind of gross slowdown and people were kind of very doomsday, but the 10-year bottomed early August and has been going up ever since. The yield curve bottomed early August and started to go up, and that was followed by the more economically sensitive stocks starting to outperform the defensives. Utilities was one of the worst performing sectors. So the market has been screaming that the economy was not going to roll over for quite a while now, and it feels as though people are waking up to it. So the call of a big correction, I thought, was completely misguided because the internals were saying, no, economy was strengthening. And my experience is, a big correction occurs with a growth scare, not a growth acceleration.
I've been watching revenues. Gina Martin Adams taught me that. Andrew, I'm looking at 3M coming out moments ago. You and I know 3M has been a challenging exercise for the last decade, yet there I'm seeing revenue growth of 9%, modeled out to 10%. I mean, the fact is it's revenue growth higher than nominal GDP. What does that signal to you?
Strength. It's strong. And look, I was on a call last night, and this, someone said, it's all prop. The market's only up because of the Fed, blah, blah, blah. And I said, wait, time out.
Thank you.
The market is up 21%.
Right.
But keep in mind, the estimate revisions by Wall Street has revised up the S&P earnings estimate this year by 21%.
Lisa,
So
are you taking notes?
Thank you. I appreciate it, Tom. He also said that the Bears are running out of time. Carry on.
The Bears are running out of time. I think next year is going to be a tougher year, but the market's going to be higher than this by year end.
Well, let's talk about next year. What are we underappreciating going into year end that you think will actually start to go the other way next year?
Well, the third year coming out of bear market is always a tougher year. You know, you look back to, if you consider 2011 was a flat year. 2002 was up 4%. You know, the market starts to worry about the Fed moving in the other direction. And so the third year is a tough year. And I think you get a combination of discussion of the Fed raising rates plus fiscal policy is moving in the wrong direction also. I think in other words, higher taxes, that's reducing liquidity. I don't think it's going to be a doomsday year, but I think it will be a mid-single-digit year. But before that, we could have quite a good move from here into year end.
Andrew, you just said higher taxes. Is that still in your base case? Your underpinning assumption for next year and your outlook that we get higher taxes?
Correct. The only question in my mind is some of that embedded in earnings estimates already? Because next year's estimates have not gone up as much as this year's. Usually when a company beats numbers, analyst raises this year and next year by the magnitude, there's been a lag into next year. So I do think there's a risk that it's not as bad as possible. But at the end of the day, it's just lower liquidity. Fiscal monetarily is not as good for our equities. It's not a disaster, but it's just not going to be as good as this year. So naturally, last year was a monster year. This year is a great year, and next year will be a tougher year.
All right, so Andrew, what do you do as an investor with this? I mean, do you just lean into risk, lean into cyclicals, lean into the trades that have been working best, and just wait for signals that perhaps it's time to shift?
Well, I think, Jonathan talked about the yield curve, but the 2 to 10 year is only 120, it's only in the, it's less than 150 basis points. And if you look back at every recession at post a yield curve inversion, we get to about 250, 300 over. And in that environment where yield curve is continuous steepen, you want to own financials, you want to own value stocks. They work. They have not repriced back to where they were. So I think there's a very big opportunity in those stocks. They're working. It's great, but it's not over yet. So I wouldn't fade them. I wouldn't sell them yet. Energy is a different animal because you have something called OPEC and so forth, controlling energy prices. But I do think the value trade is not over. Now, that's in the U.S. I've got very strong opinions on other places in the world. Tom, you mentioned real yields. You want to look at real yields going the wrong way. Look at Europe. I mean,
So wait, hold on a
nominal is up,
second,
but the
Andrew.
inflation is up more.
Are you saying that you actually are bearish on Europe right now after a story that
Correct.
really supported that?
Correct. Because real yields are going down. Rates are going up, but not as much as inflation, break evens. So it tells me that there's a higher chance of stagflation in Europe than there is in the U.S. So I'd rather own cyclical stocks, value stocks in the U.S., and this has been our position all year long, than in Europe. And at the end of the day, go look at how the XOF is done. That's the financial ETF here versus the EUFN, which is the bank financial in Europe. It's doubled the return. So to me,